If you have confidence in the economic outlook, equities are usually the best place to be.
I really think what the market is doing is it's reassessing how confident it is in the growth outlook.
That baton of growth acceleration is getting shifted from the U.S.
The data is good right now. The problem is that it's not good enough.
The Fed will actually end up doing what it has to do, but it may be a little bit late.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
This is not the summer you were looking for. From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance Live on TV and radio. Alongside Tom Keene, I'm Jonathan Ferro. With equity futures in 52 on the S&P, a break of 4,300. With us for the next few hours, Romain Bostic. Tom, we got to start with this market. Your yield, 125 on a 10-year. I'm not sure how many people had that in their outlook at the beginning of this year.
Very, very few. We've got a guest coming up in moments who really has some color to this. And John, it's not only about the single point yield, it's about taking two yields together and looking at the steepness or flatness of the curves. This is a fixed income market readjusting to a legit growth scare.
And you take the bond market move, Tom, and you look at the equity market, and for weeks and months we've been talking about rotation on, rotation off. Now we're talking about risk off. That's a real move in the equity market this morning, real de-risking in a way that we haven't seen for quite a while now.
Yeah, it's de-risking, but I looked at a bunch of charts, and I'm going to call it range-bound right now. If it moves further, John, you're absolutely right. It's a real adjustment. We forget how far, how fast we've come. I'm going to call it within the range.
You know how this works, Romain. You take the price, you build a narrative. We have a new narrative.
Yeah, I think the narrative is that some people are now at least looking at the eggs and not necessarily rotating completely out of this market. But when you, Tom, when you look at the drop that we've seen in this market, and when I say drop, I'm talking about the number of participants that we've been seeing in these record highs that we've been getting to every day. It's been getting smaller and smaller and smaller. This is now a small corner of the market that people are embracing, and that's it, Tom.
John, let's stay on the markets, but did the ECB move this market? I don't see it.
No, not at all. We can talk about the ECB a little bit later.
Yeah, I agree.
Look, for this equity market, we're at 42.94 on S&P 500 futures. For the S&P 500, the year-end median forecast is 4,300. We've had a massive run-up in this equity market,
looks like an entry
Tom.
point to me.
It might be for you.
You know, Abby Joseph Cohen said, they're going to revisit this with Mr. Costin at Goldman Sachs and the others as well. The bear case is out there, John, and I've got to admit, the bear case is about GDP slowdown comes sooner rather than later. That's the question for later this year.
Well, the Goldman call is 4,300, and deceleration is certainly the theme right now. So if you look at the bond market move, one, we've got a squeeze. Then you've got this whole narrative around deceleration. And then you've got the emphasis shift over at the Federal Reserve. And Romain, I think that's key in a lot of this too.
I think so too. And I also don't think it necessarily needs to be a bear case versus a bull case here. I think there's a case of stasis right now. The idea here that you're really not going to have much of a catalyst to move things higher. There may not necessarily be a catalyst to move things much lower here. But you talk about entry points. If you're already invested in this market, you've done pretty well, Tom. I mean, why would you really, go further out on the risk spectrum at this point?
Romain, that's the problem. He is not invested in this market.
I don't
always forget.
Here's your Thursday morning price action. 42.92 on the S&P 500. We're down by 57. We're negative by 1.32%. Negative on NASDAQ 100 futures as well. Likewise on the Russell, some underperformance there on the small caps. Outside of that, into the bond market, the bid is just relentless. Yields are lower again by 5-6 basis points to 126.12.
Look
Tom
at the
Keene, 126 on 10s. Okay, the 30-year, 188. Do you know what the year-end forecast, median year-end forecast on a 10-year is? 188 on a 10-year. 188, and that's where, Tom Keene, the 30-year is right now.
And the tip, the real yield, I mean, your real yield show tomorrow. John, you've got to blow it up today to do a better show tomorrow.
The negative real yield appearing on Bloomberg TV at 1 p.m. Eastern tomorrow afternoon. Shahid Ladhar joins us now, being prepared by our head of strategy for G10 rates. Shahid, there's only one place to start, isn't there? 126 on 10s. What's going on?
Sure, a lot in bonds, and bonds I think have driven or at least led some of the most recent moves. I think there's a few things in play. One is a persistent bid, excess liquidity and ongoing Fed QE. And another is a much deeper underlying demand for duration than was appreciated earlier in the year. I think this comes from two homes in particular. One is US corporate pensions, which are much better funded, with higher rates and tighter spreads and higher equities. And secondly, and perhaps most pertinently currently, is demand from banks. Banks' business models are somewhat challenged with the influx of deposits, with liquidity, the amount of liquidity in the system, and it's finding its way into bonds and rates across the curve.
Sure, I love your note and the way you look at the spread market, and you try to game out how we're going to go forward. And you've got a great phrase called calculated patience. Right now, we're all living a narrative day to day. Today's narrative is doom and gloom. Lisa, we miss you. And Shahid, what I want to know is, what is the narrative of calculated patience? My history book says that doesn't happen.
Sure, it's difficult to think about patience in a world of fast-moving markets, and particularly in fast-moving economies. So we've gone from, of course, a unique shock and a unique fiscal and monetary response, and the timescale of both the shock and the recovery are unprecedented. So indeed, our horizons have become incredibly even more short-term than perhaps they were, and even more difficult to wait or to frame patience. But perhaps how I think about the Fed and its reaction function is, the Fed's told us they're talking about taper. The Fed's put in some dots for 2023 and thinking about liftoff eventually. It's done this whilst equities are still broadly close to the highs, and bond yields, the long end, are certainly at the lower end of the spectrum. So one might flip the script a bit and suggest that the Fed may have got away with a hawkish kind of tendency without causing any type of tantrum in the market. In itself, buying time in terms of financial conditions to get to the exit point, perhaps with taper announced in September, enacted next year.
Yeah, I mean, obviously, Shahid, for all the agita here that is expressed on this program and other programs here, some of the rotation that we've seen in the market has been relatively orderly. This isn't really people rushing for the exits, people basically trimming positions, maybe repositioning for whatever the new normal is going to be. Do you think that is going to be effectively the playbook going forward here, or do you think there is still a surprise, still a shock that could come out of the Fed and out of the other central banks?
So I think in the near term, I think the Fed's put some of its cards forward, and I think it'll be waiting for evolution of particularly labor market data, perhaps inflation data through the summer, to calibrate the timing of at least exit from QE and then beyond, in terms of liftoff through probably 2023, in our view. In terms of how the market trades then and what forces could be important to it, if the Fed is possibly or probably not expected to move things or move the needle in July, then what could matter? And I think the government, a story around the debt ceiling, particularly with respect to the level of liquidity in the system, we're talking about here is the amount of reserves, which obviously have increased exponentially with QE4, have found some type of a drain or sterilization through the domestic RRP program. And the question for me, and a key question for the second half, is how does the outlook for liquidity look like? Because if it continues to grow at the 1 trillion we had in Q1 or the few hundred billion we had in Q2, then that argues for a continuation of flood potentially into fixed income. However, there are potential turning points, and the potential turning point could be that Treasury cash is no longer at some point going to fall, maybe after July, depending on the debt ceiling, and therefore can actually rise, and that could take away liquidity. So we could be in a bit of a liquidity paradigm where excess will stay excess, but the change may stop going up.
Shahid, bear with me a second. I just want to jump in. We just took another leg lower on the S&P 500, 42.93. We're down about 1.3%. And if you're just tuning in on TV, on radio for our audience worldwide, we're down 5 basis points on a 10-year to 126. Shahid, this is where I want to wrap it up, and I'll make it really, really simple. If the Federal Reserve is going to start moving further towards tapering, is that bullish or bearish for Treasuries?
We think ultimately it's bearish for Treasuries, but a lot less bearish and a lot less messy, if you like, than it was in 2013. I think we need to watch real yields and break-evens. Yes, we have a little localized risk-off in equities overnight, but real yields remain extremely low. Break-evens remain relatively high in their 1 or 2 year range, even longer for break-evens. So I think financial conditions remain accommodative, and we haven't seen really major signs of tantrum or broad risk off, and neither do we expect that this year. So a relatively tantrumless taper is what we're calling for here.
Shahid, good to catch up. Shahid Lahad there, BNP Paribas head of strategy for G10 rates. Your rates this morning are lower. Yields are lower by 5 basis points on 10s to 126 on 30s. TK, you brought this up. We're down 6 basis points there. A break of 188 on a 30-year yield in America.
And I think the key thing is on 2-10 spread. The difference in yield, folks, between the 10-year and the 2-year, to get that under 1 full percentage point is another symbol. John, I'm going to go back to, we've been moving awful quickly on a lot of the market, and we're just giving it up. But, John, the key thing is we're giving it up on a growth scare. And, John, I think it's really important. Oh, I tripped. Oh, my God. John,
is that Raheem Sterling?
John, I'm sorry.
Is that Raheem Sterling?
I didn't mean to do it.
I didn't think you wanted to do football this early. Do you want to do football now?
God, it's too much.
Is that Sterling?
Oh, I just fell. It was Sterling was Sterling. Let's put it that way.
I think
John, what a
Luke
joke.
Cowell went out on Twitter yesterday and said he hadn't seen Sterling dive that much since 2016. For those of you that understand the Brexit joke, you get it. But boom.
Oh, I get. Oh,
get it?
GDP,
Nice, right?
Only
Look, Raheem Sterling, quite easily. TK, Raheem Sterling has been the player, I think, for England in this tournament, and it's such a shame that he ended that game by doing that. The way that game was won, I think, is going to leave a bitter taste in the mouth of both the neutrals and the Danish as well.
Romain, if somebody on the Chicago Bears had done that, they would have been beaten to death up in Green Bay, right?
Yeah, I think so. I don't know what's happening on the show. We're 11 minutes into it. Tom's already doing it.
We're doing soccer talk. It's important. Come on, John. Italy, England. Who's going to win? Get to it.
Oh, Tom, you want me to choose?
Come on, let's go. Italy to England now.
Look, when it comes to nations, my loyalty is split. When it comes to football, I said this yesterday. When you grow up and your father's Italian, the blue jersey goes on and nothing else comes close.
There we go.
So when it comes to Sunday, and football exclusively, it's Forza Azzurri.
I fell down.
Coming up in the next hour, Jonathan Gold of Credit Suisse, Chief U.S. Equity Strategist from New York City this morning.
I wasn't
your equity
even near the goal.
Breaking down 59 on the S&P to 42.90. A bit into the bond market, yields lower. It's a risk-off Thursday morning. Forget your easy summer trading. This summer gets interesting.
How come he gets to score on the rebound after the goalie made that great slave?
You need the appropriate tone this morning. Let's do sport a little bit later. Focus. The big bull on Wall Street, Mr. Golub of Credit Suisse, coming up a little bit later. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. In Haiti, police reportedly have shot and killed 4 suspects in the assassination of President Jovenel Moïse. According to the Associated Press, 2 others were arrested and 3 police officers who were being held hostage were freed. Still no word on who the assassins were. Japan may be moving closer to a no-spectator Olympics. An advisory panel has recommended approving a state of emergency in Tokyo for the entire period of the Summer Olympic Games. According to Asahi, fans would be banned from attending Olympic events in the city. Bloomberg's learned that the European Central Bank policymakers have agreed to raise their inflation goal to 2%. Plus, they will allow room to overshoot it when needed. That's a big change from the previous target of below, but close to 2%. And in soccer, England will play in a title match for the first time in 55 years. Harry Kane converted the rebound after his initial penalty was stopped in extra time to give England a 2-1 win over Denmark in the European Championship semi-finals at London's Wembley Stadium. The English return to Wembley Sunday to play Italy for the championship. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
We pay for our entire plan to make the tax system fair for all Americans. It's about time. There's a lot of work ahead of us to finish the job, but we're going to get it done. We're going to reimagine what our economy and our future could be and show the world, just as importantly, we'll show ourselves that democracy can deliver. The people of Illinois and the people of America and the world can lead again.
The President of the United States from New York City this morning. Good morning. Alongside Tom Keene, I'm Jonathan Ferro. Lisa Abramowicz will be back with us on Monday. Remain bossy with us for the next couple of hours. Equity futures down 65 on the S&P 500 to 42.85. It's a breakdown by 1.5% on the S&P this morning off the back of a big bid into the Treasury market over the last couple of weeks. 125.29. Yields are down by 6 basis points, and this mood this morning is taking crude with it. We're lower there by 0.9%. TK, WTI, 71.53.
John, in the 6 o'clock hour, we've got to make clear the velocity here is to the downside. The VIX at a 19 level goes out to 20.90, so this is a market on the move.
We are sitting at session lows of the equity market and yields, I believe, at the lows of the session too, Tom. 125.29. Yeah.
We'll watch that. We'll do more data checks for you today, of course, and continue this market coverage. Right now in Washington, Anne-Marie Horton joins us, our Washington correspondent. Anne-Marie, E.J. Dionne in the Washington Post has followed the moderate and the left of the Democratic Party for decades and decades, and he has a blistering note out this morning that there is no left-wing adventurism here. In New York City in the last 3 weeks, we've seen no left-wing adventurism is there. How is the left wing doing in Washington as they adventure out into the end of July?
Well, Tom, they're certainly putting pressure on the White House when it comes to the human infrastructure bill, which we saw the president really try to get a little bit more of a PR campaign in the Trump counties in the Midwest over the past week, especially yesterday, saying when he was at that college that he was there to promote and explain why we need that second package. But interesting, you also see progressives writing to the White House when it comes to things like China about let's not go too hard on China when it comes to some things we don't agree on because we need China on board when it comes to climate. But ever so more, as you're going to see more of these bills come to the floor, there's going to have to be the Democrats between the progressives and the moderates to really come to a stance to get anything done because they are very far apart.
Dionne talks about a 3-week window. Is the Horton window as well 3 weeks? Is that really the window that we're fitting in here to figure out where the president and the Democrats end up?
Well, what you're hearing right now, and The Hill is reporting this, that as soon as July 19th in the Senate, they want to get that hard infrastructure bill done. But as you say, 3 weeks, is that enough for it to actually get done? Because many of the progressives say, and Nancy Pelosi, the Speaker of the House, has said she will not in her chamber take up that infrastructure bill unless it's in tandem with the softer human infrastructure, the multi-trillion-dollar spending that will include tax hikes.
All right, well, let's talk about some of the more hard infrastructure, Anne-Marie. I mean, there is still a lot of talk about the transportation bill that's working its way through Congress. The idea here that, some of the bridge and railroad projects, the more traditional infrastructure needs that we have in this country, that there is a little bit more support out there to actually get this done, if not necessarily support for how to pay for it.
There has to be support, though, if you're also considering the fact that we have midterms next year. It's very hard for a politician to go home to their constituents and say, I had a chance to vote for this new bridge, a fix of this road, and I decided not to do it. But it will be used for many of the Democrats as leverage. We will vote for that hard infrastructure as long as we get a little bit more when it comes to the multi-trillion-dollar human infrastructure package.
How much political capital, though, is being expended right now by the Biden administration on this, particularly when we know that he has still a relatively aggressive agenda that he wants to get done over the next 3 years?
Well, a lot of political capital is being used in terms of his aides going back and forth to the Hill. Of course, they're in recess this week, but making the phone calls and making the rounds. Also, you could see where the president has been making his trips recently. It's all been in the Midwest. It's all been into areas that are very much conservative and back the Republican campaign. And he's making his pitch as to why his goals for softer infrastructure and that human infrastructure is needed. I also would like to say that last week on Friday, when the president was talking about all the efforts they made and the goals and the progress, especially after the jobs report, when he was asked about foreign policy in Afghanistan, he didn't want to go there. He didn't want to talk about that. He said, it's a happy weekend, can't we celebrate? So it's very much focused on the domestic play right now.
Anne-Marie, let's talk about this market. 42.82 on the S&P. We're down about 68 points on the bond market. The yield right now on 10s, I see it at 125.29. We're back to levels we haven't seen since February. We're coming in about 6 basis points. Down in D.C., I've heard from Secretary Yellen. I know that she's been saying, reportedly, that apparently she supports the job that Chairman Powell is doing. What is the next step? for confirming Chairman Powell for a second term. Where's that conversation at now down in Washington?
Yeah, well, there's a Bloomberg scoop out that there does seem to be support to confirm Chairman Powell, and it's pretty much the way of Washington that you would keep the chair Fed in the position. The time we didn't see it is, of course, with former President Donald Trump, but it is to maintain that independence of the Fed. Right now, we have a great scoop out on Bloomberg News talking about the fact that there are other governors. Those vacancies potentially is where the administration could start to move the dial in terms of the kind of enactment they want to see on the Fed. Things like climate and things like banking, a little bit more. It's those vacancies potentially, but there does seem to be support to keep Fed Chair Powell where he is.
Anne-Marie, thank you. It's good to catch up down in Washington, our Washington correspondent. Let's pick right up on what's happening with this market this Thursday morning. We're down 66 on the S&P. We're negative about 1.5%. That's a session low. In the bond market, your yield at a session low, down 6 basis points to 125.29. It is not just a US move. You see it in the UK. You see it in Germany. Bund yields over in Germany. Your 10-year yield down 4 basis points. TK back to negative 34 basis points on a German 10-year.
I would lead with the yield analysis, John. I think that's really apt. Again, I look at the Swiss 20 as a benchmark in Europe, and it continues to deteriorate another 3 basis points and nicely into negative territory now. With that said, John, you've got to look, we got to get a handle on where the range is when you've had a moonshot market like we've had, and particularly for the NASDAQ, but even the Standard & Poor's 500, John, I've got the chart up here on the Bloomberg terminal, and I'm sorry, it's been a moonshot April, May, June, July.
Tom, I think you can sit here and say that the last couple of weeks has been a monster position squeeze, and maybe you shouldn't read too much into it, establish a narrative that you extrapolate out through the cycle. My issue with that story is, and I think the counterpoint to that, is that we are 50 basis points south of where we were at the end of the first quarter. This move is not fresh. It has been developing now, Tom, for the last several months.
Well, it has. And again, John, I go back to what the experts have told us, and there's a school out there that says that it's the when of it. We're going back to 3% growth. We're going back to potential GDP under 2% growth. But what's the when of that? And that's what we're debating in the markets this morning.
Earnings season next week. Remain have asked people repeatedly, what's important for your call on the cyclicals going into year end? Your 10-year yield or earnings? And they keep going with a 10-year yield and not earnings.
Absolutely, and I think the earnings is going to be the big picture, and you talk about how all these moves were sort of foreshadowed here. You saw that already in the cyclicals. You saw that in the small caps, really over the past couple of months. The underperformance of the Russell, that was your canary.
From New York City this morning, good morning. Your equity market lower, your bond market yields 125 on 10s. Alongside Tom Keene, I'm Jonathan Ferro, together with Romain Bostic. For our audience worldwide, this is Bloomberg. Live from New York City for our audience worldwide. Buckle up. Here's the price action. Equity futures 42.84. We declined by 1.5%. The Nasdaq down by a similar amount. Your underperformance from the Russell to small caps down by 1.8%. Session lows in the equity market. Session lows for bond yield. Switch up the board. 2s, 10s, 30s shaping up as follows. Your 10-year yield, a break of 125. 124.96. We're down by about 7 basis points now. Your 30-year at 186.53. I mentioned this about 30 minutes ago. If you look at the consensus year-end forecast in our survey for a 10-year yield, right now, end of Q4 21, it's 188. Right now, your 30-year south of 188. There's some real repricing going on here, and this is one heck of a position squeeze in this bond market. But it's something else too. Switch up the board and finish on real yields. This is what we keep going back to. This is where the move has been. We are -1. There is a minus side with a 1 next to it, and that's the story in this bond market. Negative real yields, and even more so. And I'm trying to work out the best way of framing this, Tom, because people keep going back to this term, a growth shock. Well, we had a growth shock at the start of this year as well, a positive growth shock. some aggressive repricing of what the year would hold for GDP and next year too. And now the narrative seems to be deceleration. So maybe it's the reverse growth shock that we saw earlier this year. And certainly, Tom, I think the chart captures that story quite nicely over the last 5 months.
Yeah, John, let's stay on that chart before we get to Rob Carnell. This is so important, folks. John, help me out here in that we have moved 2 basis points on the real yield from a 101 out to a 104, negative 1.04. And there in January on radio, it's real simple. The worst big negative yield was a negative 1.11, John. Has anybody we talked to, including on the real yield, see it Friday afternoon, John, has anybody framed a negative 1.12, a negative 1.15 yield? I don't think so.
I haven't heard that yet either, Tom, and I think still a lot of people in this bond market believe all this is technical, a monster position squeeze. And often what happens when you get this kind of dynamic is you get the position squeeze, you get the move in price, the narrative comes after, and people extrapolate out that narrative through the cycle. Bob Michael at JP Morgan's pushing back, and Tom, we'll work through this together because I think it's important. If you look at the consensus forecast for this year for GDP growth in America, next year and the year after, you go from a 6 handle, you go from 4, you go down to 2. Do you focus on the levels and the cumulative gains that you'll get through this economy through the next 3 years, or do you focus on the deceleration? This market at the moment is very preoccupied with deceleration. Bob Michael thinks it's cumulative gains through the next 3 years, which are important, because the cumulative gains are going to eat away at the labour market slack. And that's the dynamic that should matter for this bond market. But at the moment, Tom, that's not the dynamic that's driving this market worldwide this summer.
And that calculus, folks, is really, really important. We heard from Abby Joseph Cohen yesterday with Goldman Sachs, the idea that we would not see wage inflation as we see a reemployed America. We get lucky on Bloomberg Surveillance. One thing John and I have done when we built this platform is simply to say, get us the guests. And we've done it again. Lee and I are joined at the hip, and Lee massively lucked out today by saying we need to speak to Rob Carnell of ING. They have abandoned him to Singapore, but for years known out of London for acute monetary analysis, his work with His Majesty's Treasury, and iconic work 07, 08, 09 at ING in the crust of the crisis. We're thrilled that Rob Carnell would join us this morning. John, with your expertise on the ECB, why don't you bring in Mr. Carnell?
Hey, Rob, let's start with that. The price mandate over at the ECB, you know what it used to be, still is in fact, it is below but close to 2%. That's set to change today, reportedly to 2% with a tolerance for an overshoot. Does that change anything whatsoever for this central bank in Frankfurt, Rob?
But what it does is get rid of something that I think most of us have hated for years. I mean, we never really knew what it meant. Below but close to, was that 1.9? Was it 1.8? Was 1.7 close enough? So for starters, it gets rid of that horrible, lack of certainty over what the actual mandate was. But you replace something which was close to 2 but below with effectively 2, and you can perhaps go over for a bit. And really what we're doing is we're doing what the Bank of Japan did many years ago when it moved from 1 to 2. You take a target, you shift it, you've got no more tools, you're going to miss it by a bigger margin. So it's all about credibility, and I don't necessarily think this is going to change an awful lot.
Well, Rob, their own forecast captured the credibility issue over at the ECB. On CPI, 1.9 for this year, 1.5 for next, 1.4 for the year after. Even with any interpretation of their mandate, even with that, even if it adapts, even if it changes in 25 minutes' time, whatever it is, Rob, they're still forecasting deceleration through CPI out to 1.4 and well below this target. So is their policy stance wrong, or do they just have zero credibility now to achieve it?
Well, I think you have to wonder whether these targets are actually sensible. Why 2? Why not 1.5? Why have we chosen 2? We don't seem to be able to achieve it. This year, of course, we have all the benefits of looking back at last year's terrible price level and a nice comparison. It just lifts everything. It makes it so much easier. But that won't last. We all know that. We've got a little bit of help from supply bottlenecks that's pushing things along as well a little bit. And we've had up until now a little bit of a push coming from OPEC Plus, at least giving us the sense that possibly they might do something with supply. But that's clearly not going to happen anymore. So oil's probably heading back down again. Yeah, I mean, credibility is a tough one. But, why pin your colours to a particular number? It doesn't make sense.
Rob Carnell, frame for us the German response to what we're going to hear from Madame Lagarde today. The idea of moving from Otmar Issing to Axel Weber and on to Weidmann. Is this a different Germanic response, or is it going to be the same old, same old?
I think the German response has been mellowing over the years. I mean, they've been very, very much been Bundesbank over the years, which has been very anti a lot of the stuff that the ECB is doing, from quantitative easing to pretty much anything at the moment. But no, that has changed. And Weidemann seems to be mellowing as well a little bit. I mean, he'll retain a sort of Germanic hawkishness throughout all of this, but I think they can see that there's some merits to pragmatism within this, given that the previous policies just simply haven't worked.
John Farrell gives us that often, too, some Germanic hawkishness. We've noticed that as well. Rob, I'm going to steal from the good people over at Rabobank this morning. They make fun of the acronyms. It's like the military. Rabobank on the ECB, is it FIT, is it FAT, is it FLAT, or is it FLOP? How big a flop is this going to be, old wise one?
Well, what they can always do is they can wrap this up in all sorts of other things as well. There's plenty of other stuff as well as the target that they'll be talking about. They'll be talking about whether or not they can bring in sort of more environmental targets. They can even talk about whether they should be thinking about a different type of inflation measure, perhaps bringing in house prices into this, which they haven't done particularly well. And talking about, do they need to think about headline rates as they've always done in the past? And we know that these are flipped around by all sorts of supply measures that they have absolutely no control over whatsoever. So, there are other things that they can do to try and minimize the focus on the fact that what they're really doing is tinkering around the edges of something which is fairly marginal.
Rob, what about the other components of this review, the employment component as well as this focus on climate change? How does that fold in to the inflation outlook as well?
Yeah, that's a very interesting question, this whole employment thing, because I think one of the things we noted pre-pandemic was that there was next to no relationship between the unemployment rate and what was happening to wages growth. Now, we are seeing something now. I mean, the US is giving us, the rest of the world, an interesting lesson in what's going on there, that there can actually be a relationship again. But we still don't know whether this is, for keeps, or whether this is simply a one-off price level adjustment as we adjust to the new norms of a post-pandemic world. So it's entirely possible that in 2 years' time, we still have a point where the economy is running okay, unemployment rate is rock bottom, and you still have no wages growth. Then what do you do? So I think, a complete change of viewing unemployment as a particularly causal factor could be helpful. But then what do you replace it with? There doesn't seem to be anything else to bring in to take its place.
When you look at sort of the lessons that we can learn from the shift that Japan made, and to a certain extent, the shift in tone that we saw out of the Fed here, how does the EU and more importantly, how does the ECB, and more importantly, how does this sort of collection of countries, all that to a certain extent have different goals and to a certain extent different economies, how does the reaction, how does the outcome of this, if at all, end up different than what we're seeing in Japan and the US?
Well, it might not. I think the one thing that we're doing at the moment is we just all focus a bit more on fiscal policy. I think if you accept that a lot of monetary policy around the world has run out of pep, that it's pushing on a string, it's been doing that for many years, then you have to look at something else. And fiscal policy, it's the story that we hear about from Washington in the US all the time. It's the story that we've begun to hear about finally from Europe as well. Japan's already run that race and spent everything. So I think that's where we head back to. That's what can push things along. But the money has to be spent sensibly. You can't just print it and chuck it around in a sort of willy-nilly fashion. It has to be put to useful, productive uses.
Hey, Rob, it's been way too long. It's good to catch up. Rob Carnell there,
Likewise.
ING Asia Pacific Head of Research and Chief Economist. A big focus down the ECB. We'll hear that new strategy review, the results of it, in about 20 minutes' time or so from the ECB. And you'll hear from Christine Lagarde, the ECB President, a little bit later too. Got some news, TK, coming out of the UK.
Is.
The Transport Minister. Unfortunately for you, yes, for me, no. The UK to allow vaccinated residents to return without quarantine. Now, Tom, it's important here to understand the nuance. My interpretation of this is if you live in the UK and you have been vaccinated in the UK, you can travel now to both a green and amber list country. And from July 19th, you can return without quarantine. Here's the issue. If you are a UK resident and you try and come to the United States directly, you cannot come, Tom. That is the problem.
Why?
We do not have a reciprocal arrangement with the United States of America. And this is the problem right now. From July 19th, Tom, if you are vaccinated, you can travel to Europe, come home, back to the UK, great, no quarantine, all of that good stuff. So let me give you an example, my personal example. If I fly into the UK today before July 19th, they have no idea if they'd even recognise my vaccine, Tom. I would have to quarantine for a short while. I would not be able to fly back directly to the United States. I would have to find a third country and stay there for 2 weeks. So what a fantastic time to have the Transport Secretary of the United States on this morning, Tom. We'll be catching up with Secretary Buttigieg a little bit later. Why do we have no reciprocal arrangement with the Europeans, with the UK, ready to go for this summer to help out these airlines? Now, you might say it's the Delta strain. Guess what? The CDC told us, Tom, the Delta strain is becoming the dominant strain here in America too.
It is. I think it'll be very good to speak to Secretary Buttigieg about this. But, John, to me, what is so important here is you're vaccinated, you have a card. Why should you be restricted?
They haven't worked it out.
Just that simple.
Still, let's catch up with Jennifer Nutzer. We'll do that next from Johns Hopkins Center for Health Security. The senior scholar joins us next. Euro dollar 118.30. It's a firmer euro. That move in the bond market gets your attention, doesn't it? 124.96 on 10s. We're down 6-7 basis points, and your equity market is down 1.5% to 42.86 on the S&P. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. A 2-week search for survivors of that collapsed condo in South Florida has come to an end. The operation is now shifted to a recovery effort after authorities concluded there was no longer any chance of life in the rubble. Crews have recovered 54 victims, with 86 people still unaccounted for. In China, the government has signaled the economy needs more support from the central bank. Authorities hinted that the People's Bank of China could make more liquidity available to banks in order to boost lending to businesses. One way to do that, cutting the amount of money the banks have to keep in reserve. China's recovery from the pandemic has shown signs of faltering recently. And in China, Tesla has unveiled a significantly cheaper version of its locally built Model Y SUV. That's after a string of negative publicity may have hurt consumer sentiment towards the electric car-making pioneer. The so-called standard range Model Y starts at a little more than $42,000, about 20% less than the original longer range Model Y. And 36 states have sued Google, accusing the company of abusing its power over app sales through the Google Play Store. The suit, filed in San Francisco, says that Google used anti-competitive tactics to thwart competition. The company says the lawsuit gets it wrong. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
We have severed the link between infection and serious disease and death. And currently there are only a 30th of the deaths that we were seeing at an equivalent position in previous waves of this pandemic.
He is taking all protections off in one go. That is reckless.
A sense of the direction of travel in the UK. That was Boris Johnson, the Prime Minister, and Keir Starmer, the UK leader of the opposition. From New York City this morning, good morning. Alongside Tom Keene, I'm Jonathan Ferro. Together with Romain Bostic this morning, here's your market. Equities down 61 to 42.88, and with it, we take a dive on Treasury yields. Yields on a 10-year. A break of 125, 124.96. We are down by 6 or 7 basis points, Tom. We just keep rolling over, and this is risk off this morning, with crude down about 1 full percentage point now to $71.50.
Watching it very carefully, I'm using the VIX as a proxy here on equity out through a 2019 out to 20.69. We'll see where that goes as well. John, that new headline, let's discuss that as we bring in Jennifer Nutzer of Johns Hopkins. United Kingdom to weigh removing quarantine on tourists from the U.S. That's a big deal.
Well, let's put it together with the previous headline, the UK to allow vaccinated residents to return without quarantine. So theoretically, if residents of the UK were allowed into the United States to travel directly from the UK, Tom, they'd be able to return and not quarantine. But there is no reciprocal arrangement. There is also no arrangement for you and I who have been fully vaccinated to travel to the United States directly from here and not quarantine, even when this rule comes into force. So this is what the UK is alluding to with that second headline, Tom, to weigh removing quarantine on tourists from the US and the EU. So you and I, fully vaccinated, they still don't have a plan to let us in without quarantine.
We'll talk to the Secretary of Transportation about that. He'll be listening to Jennifer Nuzzo of Johns Hopkins, the Center for Health Security, this morning. Jennifer, I'm going to cut to the chase. We have passports. Why don't we have certification of vaccination to make your life and professionals' lives easier?
Yeah, first of all, I think we should be doing everything possible to incentivize people to get vaccinated, and telling people that, just because you're protected with vaccines doesn't mean it's safe. I mean, that is counter, I think, to the goals of trying to get more people vaccinated. I think what it comes down to, and I'd be interested to hear what the Secretary says about this, is how we actually establish vaccination proof. It probably has to be handled at the national level. Certainly those cards that you got filled out is probably not sufficient for international travel. But, the fact of the matter is, if you are vaccinated, you're protected, and we shouldn't require those people to quarantine upon arrival.
I look, Jennifer, at this moving target. When does this get fixed? John Farrell wants to know that. Maybe the Secretary of Transportation will help us. Do you see a timeline where this gets fixed rapidly, given the Delta variant?
No, and it's really tricky because, first of all, we know that there are deeply inequitable distribution of vaccines right now. So it does become a matter of international politics when basically just a handful of countries have used, more than 75% of the vaccines administered worldwide. We do also worry about the penalty that places on countries that very much want to vaccinate their public but haven't been able to get vaccines. And this would be yet another, I think, setback for them. That said, on the individual level, we shouldn't be telling people that they need to quarantine after they've already been vaccinated.
Jennifer, I'm trying to figure this out, and I know you are too. The Delta variant is now quickly becoming the dominant variant here in the United States. So what is the actual scientific rationale to still have these travel restrictions here in the United States?
Well, I mean, I think this comes down to the fact that not everybody who needs to be is vaccinated, and we're still very much dealing with that. That said, I think we do have to sort through the fact that we shouldn't be disincentivizing the people who already are vaccinated and telling them that it is a restriction for them. But we are going to see very likely, I mean, we're already seeing now about half of states reporting case increases. It's largely in states that have lower than average vaccination coverage, but not exclusively. And any state that has a pocket of susceptible individuals, as nearly every state does, could very well see case increases in the coming weeks. And so this is, I think, really a delicate time, and it really speaks to the urgency of getting as many people vaccinated as possible. And I've very long been a proponent of making the case for why vaccines change everything. And certainly when it comes to travel, it absolutely does.
You've referred to the incentives there. And just for a second, if we can just put the incentives to one side, I'm just interested in the science here as well, just purely the science, away from the behavioral science, away from the incentives. I want to understand, if a Delta variant is already prominent in this country, what's the use of shutting the border to people coming from the UK and coming from Europe? How does that help?
Yeah, well, I'm not a huge proponent of travel restrictions. I've never seen them change the epidemiology. I think at best they buy you a few weeks' time to get your act into gear. But if we looked at Australia, which has entered into lockdown, its largest city, Sydney, they had very strongly restricted travel, including not allowing their own citizens to come back if they had visited India because they were concerned about keeping the Delta variant out. That clearly didn't work despite those very aggressive efforts. So you won't hear me champion travel restrictions as the way to keep a virus from entering a country and to keep it from spreading, because clearly we have many, many examples where that simply has happened despite travel restrictions.
So
I think countries sometimes think that they'll gain a few weeks of time to prepare, maybe expand their surveillance, but unfortunately, more often than not, they usually squander that time.
What about testing, though? I mean, where do we stand with regards to the pace of that? It seemed like that had been pulled back a little bit, and now, of course, with the emergence of the Delta variant, you're seeing at least some governments try to step up testing back to levels that maybe we saw during the height of the pandemic.
Yeah, so in the U.S., testing capacity has greatly eroded, and I'm deeply concerned about this. We saw around Thanksgiving testing basically start to level off, which was very confusing because the United States went into one of its biggest surges shortly after Thanksgiving. And what it really, I think, boiled down to was that states had to kind of pivot their attention to rolling out vaccines, and they could only do one thing or another. So it was really resources rather than epidemiology that was driving the pullback in testing. I used to get weekly text messages from my health department reminding me if I had symptoms to get tested. I don't get that now. I actually had to get tested, not because I was sick, and it took me a really long time to figure out where to get tested. So this is really worrisome. We had spent a year building up a testing infrastructure that's now no longer there. And as we head into potential, surge of cases in multiple areas, we may not be as ready as we need to be.
Jennifer, Sunday, we have Jennifer Nuzzo and John Ferro with us. I mean, as you look at Italy and England, I can only assume that Ferro and Nuzzo will be looking at the giant from Napoli, Di Lorenzo. Would I be right, John?
Are you trying to cause some trouble?
I am.
Tom, is that what you're trying to do?
I'm loving it. Come on.
Are you implying that with a name like Nuzzo that
Kieran
Jennifer
made this
will be
banner
supporting
up.
Italy on Sunday?
I think Kieran
Jennifer,
nailed
I think
it with
that's
this
where he's
banner.
going.
I'm a peacemaker. My mom was born in the UK. My dad's family's from Italy. So
there you go.
They're both winners in my book.
Jennifer Nuzzo, sitting on the fence a little bit there.
I
Diplomatic
think
as ever.
she's not committed.
From Johns Hopkins Center for Health Security senior scholar. Committed to other things. I'm fully committed to my dear Italy this Sunday, Tom.
What's their style, John, versus England? Seriously.
I think that we have a lot more going for us in midfield. And I will also say that the transition from the back to the forwards is so fast. If you saw that goal just a couple of days ago, that move from the goalkeeper to Verratti, to free up the players up front, Tom, it happened so quick in just a couple of passes.
Yeah, Romain and I are watching Dodgers.
Yeah. 42.89 on the S&P. Equities down by 1.4%. Yields in 125 on 10s.
If you have confidence in the economic outlook, equities are usually the best place to be.
I really think what the market is doing is it's reassessing how confident it is in the growth outlook.
That baton of growth acceleration is getting shifted from the U.S.
The data is good right now. The problem is that it's not good enough.
The Fed will actually end up doing what it has to do, but it may be a little bit late.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
1:25 from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene. I'm Jonathan Ferro. Your equity market 42.95 on the S&P. Lisa is out of the building. She'll be back with us on Monday. Remain Bostic, helping us get through the price action through the next couple of hours. And here is the price action right now. Just a little bounce in the equity market, still down by 1.2% on the S&P. A little bounce on a 10-year yield, but still, Tom, 125.
Yeah.
We're down 6 basis points.
Let's partition this. So we got huge news flow this morning and really important voices to join us. Michael Schul coming up in moments. John, I agree. The range bound on equities is there. We have really not breached the range of the recent moonshot up. We got a little bit of stability with a VIX at 20.10. But I do agree with you, John. Fixed income should be the point of analysis.
And look at the curve, Tom. 2s, 10s, 105.
Yeah.
105, coming in 5 basis points today.
Well, it's come in 5 basis points, John, but it's 5 more basis points to an unimaginable 0.99. And it's amazing, John, how the whole inflationista thing has just been given up here. I also want to link it, John, to this huge surge we're seeing again in reverse repos, and also the idea of that pushing over out the yield curve into price up, yield down. We're not talking enough about price up.
And you mentioned the inflationistas. Here's the change at the ECB. They confirm their inflation goal to be raised to 2% from below, but close to 2% to just 2%. The new inflation goal at 2% with a symmetric approach.
Yes.
Just this tolerance, this introduction of some tolerance of allowing an overshoot that at the moment, Tom, they're struggling to generate.
You know, I haven't done a lot of work on this, but today is an awful good morning for John B. Taylor of Stanford University. And John, the key word there, as you just mentioned it, is symmetric. And that's really laced with a cultural history at the ECB and of European finance. The word symmetric is something.
Well, let's be clear. We're trimming the Bundesbank's wings here. Tom, let's be clear about that. If we had this in place 10 years ago, you wouldn't have had the Trichet hikes of 2011. Where we are now, If that's your goal, okay, do you need to change your policy because you're not forecasting inflation anywhere near to that?
Right.
2 years out, 3 years out.
And Jean-Claude Trichet, Mr. Trichet, if you're listening this morning, dial 1-800-SURVEILLANCE. We'd love to talk to you about this. But, John, you look from, Maastricht Treaty and out on through Trichet, through Draghi, and now we can't underplay in America. This is a really historic moment for Europe.
They've added some climate change considerations to monetary policy as well. These headlines coming out from the ECB. I understand we'll hear from Christine Lagarde, the ECB president, in about 90 minutes' time. But we need to reflect on this equity market. It's a move of 53 points on the S&P. It's more than 1% lower. In the bond market, a break of 125 briefly. Right now, 10s, 125.62, in about 6 basis points. And Romain, you've got to say, this bond market right now, how we're set up on 10s, on reals, on 2s, 10s, on a curve, it makes that cyclical trade in the equity market quite difficult.
It makes it quite difficult, and we should point out the bond market really has been sort of the traffic light for the equity market for the last few months now. The bond market got it right earlier this year, I think, when it sort of led what effectively sort of front run what ended up being a pretty massive equity rally. I think the signals that we're getting right now are showing you that maybe the trepidation is sort of justified, and you already saw that in the cyclicals. Remember, folks have sort of been piling out of the cyclicals now for really the past 4 weeks. The underperformance of the Russell, very significant, and I think what you're seeing here this morning, also significant. Remember, we really haven't opened lower on the S&P 500 really for about 3 weeks now. I think there was 1 day in there, and we ended up closing higher.
What you're alluding to is important, Tom. It's this idea that it's not new. This move has not developed over the last week. It really started, arguably, from the end of Q1, when nominal yields topped out on 10s, break-evens topped out in May, and you started to see this spill through the equity market over the last 4 weeks or so, maybe even more.
It's spilling through equities. I would say bonds are more adjusted. We talked about convexity yesterday, the second derivative in bonds. Romain, I don't see convexity in the equity markets. No. I see a 1.7% pullback. I believe it's an SPX. We're nowhere near a correction, Romain.
No, nowhere near a correction. But again, you fold that back into what you're looking at with yields, particularly with a real yield at negative 1%. And you have to ask yourself, what does that say about sentiment, about whether it's the cost of money, and I guess how does that feed into the sentiment about the growth story here? It's a reassessment, Tom. People aren't necessarily rushing for the exits, but this is a big reassessment when you're standing at 4,300 and whether you say, that's it, that's the mountaintop for the year.
John, help me here with owner-occupied housing. I mean, I'm an amateur at this. I look at the way Hungarian mortgages are based off Swiss franc, the oddity of the English market, et cetera. How big is it a deal that they're doing like we do OIR, that they're going to bring that into their inflation calculation?
In many ways, Tom, the criticism of many of these central banks is they've never really taken account for how people experience everyday prices. That somehow the inflation numbers they look at are somehow divorced from the inflation that we experience. So allow me to whip through the headlines, Tom. We've got this new symmetric 2% inflation goal over the medium term of the ECB. You throw in the climate change consideration for monetary policy. That's something President Lagarde's been talking about for a while. And the headline you mentioned just briefly, recommending owner-occupied housing to be included in inflation. This new strategy will start July 22nd. That's the next ECB meeting. And I do wonder whether they have to recalibrate policy to meet these new goals. Let's bring in Michael Schowell, Market Field Asset Management CEO and Portfolio Manager. And Michael, let's just start with the price action du jour. We're down 56 on the S&P. Yields are in 6 basis points to 125. What does that tell you?
Well, I think you've had a correction in cyclical equities, which goes back to May 15th with a lot of things, which are down 10, 15% since then. It's not tragic in terms of their year-to-date performance. Growth has been able to ignore that for most of that time. And, I think that sort of gap between growth and cyclicality has got too far. And that portion of the S&P probably has to come down now. I think the bond market, again, yields have been correcting, bond prices have been breaking out. For several weeks, there were obvious technical levels that had to hold in order for this to stop. 140 in the 10-year and the 200-day and the 30-year both got breached. And if when you see an obvious technical level overwhelmed, you'll get follow through like this.
Michael, you've got a great synthesis here. Let's do the cliche of the glass half full. Is the glass half growthy now worldwide, or do you really suggest some form of growth slowdown, the fear of the stagflation the gloom crew talks about?
I think it depends on what you're looking at. I do think there's a threat to the sort of pure reopening trade, that some of those sort of COVID-sensitive sectors have a harder summer than people were hoping for. But if you're looking at sort of what I would call heavy growth, again, the durable goods economy, industrial activity, all of that kind of stuff, looks to have multi-quarter momentum behind it. And you will get periods of setbacks in equity markets because, that's simply what they do. But I still think we're in the middle innings for that portion of the global economy.
When you look at the price action, it doesn't appear, Michael, at least on the surface, that anyone is really necessarily pulling cash out of the market in any sort of meaningful way here. If that is the case, if that is true, if that is what we're seeing here, what does that tell you here about the potential for the market to actually rebound?
I think we'll know a lot in a few hours' time. I mean, I think it depends how the market's going down. If it's the stuff which is overshot coming back, I think that's really actually quite healthy. What you'd want to see is some of the cyclical sectors which have lost ground, start to show a little bit of resilience. One thing we have seen in the last couple of days is that gold, is showing signs of stabilizing, and that might be important because gold has really been a pretty poor place to be since the late summer.
Michael, you know the story, though. This debate was about the cyclicals not just winning the year, but winning the cycle, potentially. That the banks would outperform somehow big tech, that this cycle was going to be different. The trajectory of this recovery would be different, not just through this year, but through the next several years in a way that we didn't see that in the previous cycle. Therefore, your investment strategy needs to change. Is that still the case? Has anything you've seen change that?
No, I don't think a 6-week period like this would change anything. I'm not particularly dogmatic about banks versus technology. To me, cyclicality is more commodities, industrials, shipping, logistics, all of that kind of stuff. And as I say, the demand-supply imbalance, still looks very attractive as far as the corporate sector is concerned. But this stuff isn't straightforward and doesn't move in a linear way. And you talked about the euro crisis a few minutes ago. People thought that was the end of the 2009 bull market at the time.
Yeah, and how wrong they were on so many levels. Michael, it's good to see you. Michael Schauer, Market Field Asset Management CEO. On a fascinating session this morning, once again. We're down by 56 on the S&P to about 42.94. We've got a break of 4,300. A break of 125 earlier on 10s. Right now, Tom, 125.62. We come in 6 basis points.
Yeah, there's a little bit of calmness here within the very difficult morning. Dan Alpert just put out an absolutely brilliant tweet.
What did he say?
Of course, the age of oversupply. He says, look, we've run out of bonds. We've got overnight repos, moonshot up. Zoltan's done a great job on that, and many others, Ira Jersey at Bloomberg as well. But he says, we've run out of bonds. John Templeton personally told me, John, when I could shave once a week, he said, Tom, there will be a shortage of bonds.
That wasn't the story.
And that's where we were.
When we came into this year, and we were talking about Washington, D.C. and the free spending
my word,
Democrats.
The issuance of bonds were all going to die.
The deficit and the bond market. And here we are, Tom, at 125. Now, arguably, some people think part of peak everything is peak fiscal as well. That the enthusiasm to do the free spending many people thought would happen, some people feared would happen, hasn't developed in the way they thought.
I mean, in Romaine, it's real simple. We miss Lisa so much. We've got to talk about the pendulum of a bond glut because that's what we were going to have.
That was the narrative. But look, this is also sort of a bet, I think, on the idea of duration and the idea here that if the Fed does stay put and stays put for a little bit longer here, then I guess in some sort of perverted sense here, 125 maybe looks attractive.
Is it because people think the Fed will stay put or because people think maybe they've got a bit of an itch here? Remain.
Yeah.
That the risk management, the balance of risk around inflation has shifted, and you saw that yesterday in the minutes.
Absolutely. You saw that in the minutes, and I think you're seeing that in some of the money flows as well.
Romaine Bostic, Tom Keene, Jonathan Ferro, counting you down to the opening
symmetric.
A couple of hours away. Coming up next, in the next hour, we'll catch up with Pete Buttigieg. What a timely conversation.
I'm going to ground.
With the Transportation Secretary from New York City. We're down 57 on the S&P to 42.92. Your bond market is bid. Your yields are lower, 125 on 10s, on radio, on TV. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. In Haiti, police reportedly have shot and killed 4 suspects in the assassination of President Jovenel Moïse. According to the Associated Press, 2 others were arrested and 3 police officers who were being held hostage were freed. Still no word on who the assassins were. European Central Bank policymakers have confirmed that they are raising their inflation goal to 2%. They also recommended that owner-occupied housing be included in inflation statistics. Meanwhile, climate change will be considered in the ECB's monetary policy. Japan may be closer to a no-spectator Olympics. An advisory panel has recommended approving a state of emergency in Tokyo for the entire period of the Summer Olympic Games. According to Asahi, fans would be banned from attending Olympic events in the city. And the European Union has imposed fines totaling $1 billion for Volkswagen and BMW. Regulators say the two companies colluded to delay the rollout of emissions cleaning technology. Mercedes parent Daimler avoided a fine for being the first to tell the EU about the cartel. And in soccer, England will play in a title match for the first time in 55 years. Harry Kane converted the rebound after his initial penalty was stopped in extra time to give England a 2-1 win over Denmark in the European Championship semi-finals at London's Wembley Stadium. The English return to Wembley Sunday to play Italy for the championship. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Inflation, I think, is going to be less temporary than they think it is. It's true that there is a supply shock, which is temporary, but the real reality here is just demand is really jumped a lot because of a very expansionary fiscal policy and pent-up demand because most Americans are financially much better off than they were before the pandemic, and they have been able to spend.
That was Rick Mishkin there, the Columbia University Graduate School of Business professor from New York City this morning. Good morning. Alongside Tom Keene, I'm Jonathan Ferro. Together with Romain Bostic, Lisa Abramowicz will be back with us on Monday. Here's the good news for the equity market bulls. We're off the lows. Here's the bad news. We're down 55. We're negative 1.26%. And the bid is back in this bond market again today. We're down by 5 or 6 basis points. Off the lows as well on a 10-year yield. We did have a little look at 124. 125.96 is where we are at the moment, Tom. We come in 5, 6 basis points.
Yeah. Watching it very carefully here, both in bonds and equities as well. I should point out oil giving us some stability and, frankly, less demand, more of a less growth tone. $73 on Brent crude. Jet Fitzpatrick with us now from Bloomberg Government. John, I know you want to talk about some of the debt ceiling dynamics. Jack, I do have to talk about 1915. There was an assassination in Haiti before World War I, or the U.S. involvement in World War I, I should say, and we sent the troops in to Haiti at 689 miles from Miami to Haiti. Haiti is not Cuba, but Haiti is close. Are we going to send the troops in again?
I would not expect that. There's been not necessarily a forceful response just yet, as we're still watching everything play out in Haiti. But we're watching a Biden administration that obviously is trying to be less interventionist than in recent years. So really, to be honest, it's been a fairly quiet response so far. Obviously, still as this the story is playing out, but a fairly quiet response so far from the Biden administration and even from lawmakers in Congress.
It is early days, frankly, for a State Department tone. Is there a State Department tone on our domestic sphere, almost a Biden doctrine on the Caribbean, Central America, and South America?
In the Americas, I'm not sure you could say they have set a very clear tone. I think in the early days of this administration, the Biden administration has looked to cast its eyes over to Asia, probably more than anything else, and largely has attempted to shift from the Middle East to Asia. Obviously, you can't focus solely on what you want to focus on in foreign policy, but I think based on they're focused on Asia and the things that have popped up elsewhere, issues with Russia, issues in the Middle East with Israel and Palestine, we really haven't gotten a distinct tone or or that much of a vocal focus from the Biden administration on sort of setting the agenda in the Americas.
Jack, we've got to sort out the agenda here in the United States for America, the domestic story. What's happening with the big debt ceiling debate?
Yeah, so technically their deadline would be August 1st. There is now an expectation that they can kick that probably past September 30th. That is sort of the guidance that lawmakers are relying on, according to the House Budget Chairman, John Yarmuth. If they can do that and the Treasury can use extraordinary measures to get them into October at least, that could be tied up with negotiations to fund the government. Secretary Yellen seems to have at least privately pulled back on some of her very urgent words about trying to get this done early. And there were some conversations between her and lawmakers, after which lawmakers came out and said this is going to wait until probably October, if not a little bit later. And they're hoping that there's nothing unexpected that comes up with the pace of spending. But there is an expectation that they're going to try to get something bipartisan done that could be locked into and tied up with government funding debates that would come up starting in September rather than anything really urgent now.
Jack, just quickly, you mentioned it, so let's go there briefly. Secretary Yellen used some pretty dramatic words to describe the urgency of needing to settle this. A highly experienced policymaker down in Washington, obviously on the monetary policy side and now in the Treasury. Jack, what was she doing?
She may have gotten a little bit out over her skis. Very shortly after she used the strong words saying really Congress should, if not needs to, should address this before August, she met with some lawmakers on Ways and Means afterwards, would not take questions on it, and a number of lawmakers later followed up saying that she had claimed her words were misconstrued and that she wasn't trying to pressure them too much too fast, and that lawmakers instead were going to wait on this and believe they had enough time, so that this was more of an October issue than a now issue. And she hasn't pushed back on that new interpretation. So it's a much less aggressive stance right now than what she vocalized in a committee hearing a couple weeks ago.
Yeah, real quickly here, Jack, the issue going on right now with China, of course, all the drama surrounding the DD listing. We've seen a couple pieces of legislation be pushed forward here yesterday, including from Tom Malinowski, and there were some pretty strong comments out of Marsha Blackburn of Tennessee here. Any real impetus here in Congress right now for some sort of formal response to what's been going on in China?
From Congress on a formal response, we're still in the early stages. Obviously, Congress is motivated to get going on bills relating to China, economic competition with China. That lately has been more on the R&D side. In terms of responding to the latest news, bill introductions, statements from lawmakers, that's what we're watching for. But in terms of something really moving forward, we are still sort of in the early stages.
Hey, Jack, good to catch up. Jack Fitzpatrick there, Bloomberg government reporter, and the team at Bloomberg News reporting in the last 24 hours that the Chinese firm LinkDoc is said to have halted its US IPO plan to remain not exactly surprising.
No.
And Tom, I think remain right to bring this up. We had a Chinese company come to US capital markets, tap those markets for billions of dollars, and then the Chinese Communist Party gave them a good slap around the head and clamped down on the company. Now, you get to decide your interpretation. I won't give you mine.
Well,
either this was about clamping down on US investors and firing a warning shot here, or it was a warning shot for the Chinese company itself.
John, I'll bring it one over, and I'm not editorializing here. I'm just wondering, and of course, this, John, is my plaque at the M Bar at the Mandarin in Hong Kong. John, what does this mean for our banks in Hong Kong? Seriously. What does it mean for our banking relationships in Hong Kong?
What does it mean for the banks also that are listing these companies here in the United States remain?
Yeah, and I think the legislation that really, the one that Malinowski is pushing, I think this is sort of maybe a sign of what's to come here. I think Congress is going to try to take some sort of formal step here. Whether it sticks, it'll remains to be seen.
Remain Bostic, Tom Keene, Jonathan Ferro, counting you down to the opening bell, 2 hours away. In about 65 minutes also, you'll have jobless claims in America. Some important economic data coming a little bit later this morning. 42.95, we're down 54. We're off the lows, still negative 1.24% on the S&P. Yields are in 5 basis points to 126.79.
Denmark should have won.
And euro dollars at 118.42. On radio, on TV, this is Bloomberg. Live from New York City on TV and radio for our audience worldwide. Good morning. Here's the price action this Thursday morning. 42.95 on the S&P. It's a breakdown on the S&P by 1.25%. Outside of that on the Russell, that's where your underperformance is. We're off by 1.75% on the small caps. On a NASDAQ, down by 1.26%. And it's the same old debate. What do you want to own? Growth, value, the cyclicals, the big tech, all of that good stuff. And it's all largely off the back of what's happening here. Switch up the board and get to the bond market. Your nominal 2s, 10s and 30s, your 10-year yield, 127.45. We bounce off the lows of the session. We're down about 4 basis points or so. On a 30-year at 188, a couple of important things to think about here. 188 is your year-end median forecast, not for the 30-year, for the 10-year. This is a market caught off guard. It's a squeeze. And when you get a squeeze, you start to get some people building some narratives, including myself, and then those narratives get to extrapolate out through the whole cycle, and you wonder whether that's the right thing to do this morning. Your 10-year yield, 127, so where are we? About 40 basis points south, 40, 50 basis points south of where we were at the end of March on a nominal 10-year yield. The 2s, 10s curve is just about holding its neck above water here, above 100 basis points. We were pushing 160 at the end of March, and my point here is this isn't a fresh move. It's not new. It's been developing now for the last several months. But here's the chart I want to show you. The most important charts sometimes are the most simple charts. You can take a picture of real yields, of nominal yields, and we'll be ducking and diving all over the place. But if you take a nice clean picture of the S&P 500 over the last 12 months, Tom, the picture's pretty clear, isn't it? It's up and to the right.
Oh, really?
Regardless of what's happening in the bond market, it's just up and to the right. And it keeps on going.
John, it's hugely important. And, I don't have it ready now, but you put up the banner of the 12-month return on the equity markets. And, John, I'm really glad you put the persistency here of the Standard & Poor's 500. We're doing the nuances of NASDAQ this and that. And, Romaine does the individual stocks. But, John, I'm sorry. It's a bull market. That's what it is.
And the reason I do this, Tom, is because we've talked so much about guessing where the bond market will be.
Yeah, exactly.
And what it will mean for the equity market and individual components of it. We've had a lot of people come on programs like this one through the last year and talk about active management is going to be so important this year. Look at the S&P up and to the right over the last 12 months.
I think it had a lot to do with window dressing June 30. I'll be honest, I think they're behind in the moonshot on Amazon and the rest of it. I think that had a lot to do with it.
Something to think about. We'll catch up with the biggest bull on Wall Street, Jonathan Gulliver, Credit Suisse, in just a moment. Looking for 4,600 on the S&P. Before we get there, some stocks to look at. Morning, Romaine.
Hey, good morning, John. Yeah, obviously this is a bull market. The latest leg of that bull market was driven, of course, by those big cap tech stocks. And I say was because at least for today, there's a little bit of a breakdown there. Now, whether this is a longer term breakdown or simply a little bit of profit taking is going to take a few more days, maybe in a few more weeks to find out. But right now you're seeing Apple down a couple percentage points here in the pre-market. Similar story for Amazon and Microsoft. All three of those names closed at record highs yesterday. All three of those names are up double-digit percentages just over the past 5 or 6 weeks alone. So when we talk about this narrative of a backtrack away, I guess, from the reflation trade, well, I guess there were signals of that already. The fact that these three names had been embraced, you flip up the board, three names that hadn't really been embraced for the last 5 or 6 weeks. It was a lot of those travel stocks, the Carnival Corps, of course, the United Airlines and the other airline stocks, and a lot of those material companies, including Freeport McMoran. Those names, they've been down by double-digit percentages since the beginning of June here. Carnival down about 4% here in the pre-market. United Airlines down about 3%, and Freeport McMoran down more than 3% here in the pre-market here. So this is a little bit of a rotation going on, a little bit of a push and pull amongst investors who are maybe trying to decide whether this bull market can continue, but more importantly, if it does continue, where the leadership is going to be, guys.
Romaine, thanks so much. Hugely valuable there. Look for Romaine this afternoon as well. Right now, we've been just thrilled with what our booking team has done to bring in equity voices. Liz Ann Saunders with us. Ed Yardeni, yesterday Abby Joseph Cohen, and now we continue with Jonathan Golub of Credit Suisse. His calls early in the year were distinct, and they were different. We get an update this morning. John Golub, can you give me S&P 5,000 this morning? I got to make some news.
I don't know if I can give you S&P 5,000, but the things that have made me optimistic about the market are still in place. And more than anything else, it's earnings. We're going to start to hear, I think it's next Tuesday from JP Morgan and the big banks. The consensus view is that we'll have 61% upside in earnings versus a year ago. Our read is that that number is going to be 75%, and if we're wrong, we're too low.
Okay, so this is really important, folks. We're going to stop the show right now because this is critical. We're going to get to that earnings call. We all know consensus is different now than it's ever been. John Golub, can you make a shift to secular growth based off those earnings, or do you got to hide in a hole because the world's going to come to an end 18 months later?
No, I mean, I don't think that this story is changed as much as the headlines are. I think there's two battles. The fundamentals are unbelievably strong. This is going to be the strongest GDP quarter we've seen. The economic data is generally very good and continues to improve. Value is cheaper than growth. Cyclical, old economy, boring companies are delivering stronger growth. These are companies like mining companies, things like that. Now, if you look at what happens, however, when interest rates fall, the market favors growth stocks in a falling interest rate environment. This is all of the market is great. The question is just, as you guys have mentioned, where's the leadership? What wins within the market? Because the market still wants to go up and to the right.
John, why can't I just buy the market, buy the S&P? Why do I have to get into the detail? Why is it all about active management this year when quite clearly you're doing okay just holding the S&P 500?
John, I don't think that's a terrible call. If you are a hedge fund that's watching this show, you don't have that option. You have to try to figure out how you're going to outsmart the market. And for them, I think the story is between now and the end of the year, value wins, cyclicals win, and that there will be a time for growth, but it's not right now. If you're a long-term investor, whether you buy the broad market or whether you buy these tech themes that Romain highlighted, we're selling off. Long term, it's a growth story. So if you're an individual, you could ride the wave that way. If you're a hedge fund, you got to play this more tactically.
Let's put a bow on it then. Let's make the big point. What's more important here, the earnings or where the 10-year yield is? Because, John, I've asked that question repeatedly in the last 24 hours, and they'll say the latter, not the former. I can sense that you think it's very much about the former. It's about where the earnings go.
Listen, if you're looking at the overall market, the whole thing is an earnings story. As a matter of fact, for all those that are talking about how expensive the market is because stock prices are up, there's been no increase in valuations and PE multiples in a year. The stock market is moving only with the earnings story. If you're looking at this in terms of within the market, growth versus value, tech versus financials, then it's about interest rate. But the market, it's an earnings story, full stop.
Put it into perspective here, Jonathan, how resilient the earnings picture has been. I mean, there's been obviously a lot of disruptions. There's been a lot of talk about supply chains. There's been a lot of talk about wage growth. The idea here that all these sort of various factors would somehow upend the earnings picture for some of these companies. And overall, at least on an aggregate basis, it's held up pretty well.
Yeah, Romain, you make a good point here. First of all, the smartest question I recently got was not what is this year's earnings versus last year, because we know last year was a beaten up number. What does it look like compared to 2 years ago? Are we above prior peaks? The expectations consensus is that we'll be about 9% above where we were 2 years ago. Our estimate is that we'll be 19% above by the time all the reports are in for this quarter. So. Yeah. That's really amazing. We still have all this disruption. We can't get the things that we want delivered at all. The unemployment rate is high, and yet we're talking by the end of this quarter, we'll probably have 20% stronger earnings growth than we did before the pandemic started.
I mean, Romain Golub talks about the smart question he got 4 years ago there. No, the best question Golub got, Romain, was John Farrell's question a moments ago. Are we supposed to be worried about earnings or the 10-year yield? That's the money question.
Yeah, I mean, that is the money question. And look, I mean, obviously, Jonathan, you know, people are going to obsess over this. They're going to obsess over 125 or whatever we are now. They're going to obsess over whether we're headed towards 1% or whether we're headed back up towards 2% here. I mean, provide some sort of soothing advice here. What do you tell people who are maybe staying up late at night, staring at their screens the way John and Tom do on this 10-year yield?
Right.
Yeah.
Well, you know, first of all, if you take a look, I made this comment, I guess probably about 8 weeks ago, when we were about 150, which means that we were an equal chance that we would get 150 on the 10-year, equal chance that we would get to 1% or 2%. And I was really vocal that if you end the year closer to 1, the market is going to be weaker than if you end the year closer to 2. The market likes higher rates, and people just don't want to buy into that idea. Higher rates are an indication that demand for capital is rising. It's a sign that the economy is strong. The reason the market is selling off today is because people are asking the question, what the heck is wrong that interest rates are falling when this economy is supposed to be so good? So, you know, we want higher interest rates. I would argue that if the interest rates continue to move towards 1, that my optimism, I still think the market will be higher, that I'll be proven to be too optimistic. If interest rates back up towards 1.5, 1.75, the market is on fire.
To be clear here, John, we get a move down to 1, and that 4,600 price target of yours is in question.
I think that the likelihood of me hitting that number is lower. And on the other hand, if we get towards 1.75 or 2%, I may be too light on my number. You are right. There's no question. The sentiment of the market right now is all tied to what's been going on with the 10-year. And if last earnings season is similar to this one, the market's going to care. If interest rates continue to fall apart, the market there's a chance it just ignores the earnings. I don't think that'll be the case, though.
Jonathan Golub of Credit Suisse, Chief Equity Strategist. John,
did
good to see you. Thanks.
Did he give us a 5,000 target? I think he
didn't, Tom. He didn't. He said that if yields were higher, he might reevaluate higher. He said if yields came lower, he might reevaluate.
Come on,
or there is less chance
that.
of hitting that 4,600. I think you're being a little bit kind, Tom, about whether there was a move there or not. I don't think there was a move there. 4,600 on the S&P as year-end over at Credit Suisse.
Do you notice the difference in the show, John? I mean, Romain is so much more optimistic.
Just a little bit more, you know. I don't think Romain's got the prize that he wants to be validated by a sell-off.
No,
Tom. Should we put it that way?
It's the pendulum of soothing advice.
The pendulum of soothing advice.
Looking for soothing advice from our guest this morning. Romain Bostic in for Lisa Abramowicz. Your equity market, 42.91. It's off the lows. Your bond market, yields are off the lows too, but still...
Can we get all three of us to wear bow ties one day?
We're down 3 or 4 basis
great
points.
On radio.
We have a rule on this show, Tom. 70 plus for the bow ties. 70 and under for the ties.
Has John ever worn a bow tie?
And the older you get, the fatter the tie gets as well.
Oh, also
They're
older
the basic
you get,
rules
the
of Bloomberg
fatter the
surveillance.
talent gets. Thank you.
Coming up next, in the next hour, Eric Adams, the Democratic nominee for New York City Mayor. An important conversation in the next hour together with Secretary Buttigieg. We'll do that in about 30 minutes' time. From New York, this is Bloomberg.
With the First Word News, I'm Rishika Gupta. A 2-week search for survivors of that collapsed condo in South Florida has come to an end. The operation has now shifted to a recovery effort after authorities concluded there were no longer any chance of life in the rubble. Crews have recovered 54 victims, with 86 people still unaccounted for. Good news for some British travellers. Those who have been fully vaccinated will no longer need to isolate for 10 days when they return home from moderate-risk countries. Instead, they'll be told to take COVID tests after arrival. The UK's relaxed rules will offer a boost to the ailing travelling industry. And in China, the government signaled the economy needs more support from the central bank. Authorities hinted that the People's Bank of China could make more liquidity available to banks in order to boost lending to businesses. And one way to do that would be cutting the amount of money the banks have to keep in reserve. China's recovery from the pandemic has shown signs of faltering recently. 36 states have sued Google, accusing the company of abusing its power over app sales through the Google Play Store. The suit filed in San Francisco says that Google used anti-competitive tactics to thwart competition. The company says that the lawsuit gets it wrong. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
I'd imagine about September, October, in Southeast Asia, we're going to start seeing travel resume, firstly with domestic and then international. We've already been given word that those who are double vaccinated will be allowed in. And you see the reopening in Thailand. They've set very clear dates. So time is coming.
That was Tony Fernandez, AirAsia Group CEO from New York City this morning. Good morning. Alongside Tom Keene, I'm Jonathan Ferro, together with Romain Vostik. Lisa Abramowicz will be back with us on Monday. 42.87 on the S&P. We recover just a little bit with the emphasis on little bit. We're down 62 still. We're negative 1.44% on the S&P. Yields coming back up just a little bit as well. Once again, the emphasis on a little bit. We're still at 127.78. Yields are lower, Tom, by 3 or 4 basis points.
Are we going to have green on the screen by the time Romain does the show this afternoon?
At this rate, I think we'll have green on the screen by tomorrow or something, Tom.
I don't know.
Just at this rate. I mean, that's not me making an observation or judgment about the future.
Just
42.87 on the S&P is where we are right now.
And now it's time for
Stay
the public service part of the program. And just to get to it, because we got so much to talk about this morning, David Wilson is going to straighten you and me out on all this marketing blather of the indices. The Fang Plus index, in my opinion, is a disgrace. For starters, it doesn't have Microsoft. It's got a bunch of other noise in it, and it's basically, David Wilson, it's a manufactured index of marketing. Am I wrong?
Well, I mean, it's hard to argue against that. You know, bear in mind what's been going on with the Fang stocks. We've seen Facebook at a record this week. We've seen Amazon.com at a record yesterday. Google's owner, Alphabet, also at a record yesterday. Now, Netflix has kind of been left behind a bit, but, you know, it's a relatively small company compared with the other three. So, you know, with these Fang stocks setting records, you would expect the New York Stock Exchange's Fang Plus index to set a record as well, and it just hasn't happened. It's been stuck below a high in February, and there's a very good reason for it. There are 10 companies in this Fang Plus index, and 2 of them are Chinese. Alibaba Group Holding, the online retailer, and Baidu, the internet search company. And those stocks have been caught in, you know, the Chinese government's crackdown on companies based in, China and trading overseas.
You are expert at this. How do you treat indices that are literally a marketing plan of somebody? We got to do an index so we can get out there and be visible with Romain Vostik on the close. So they invent an index, right?
Well, and then you can have futures and options on that index. That's definitely a part of the mix as well. I mean, you just have to bear in mind that, you know, the indexes of today are not the indexes of, 4 or 5 decades ago, because so much of it is tied into trading in one way or the other. So you have this Fang Plus index, you have futures on the index, and so on. And, you don't want to just put it in 4 stocks, because if you did, I mean, it would be too concentrated. Of course, the thing is that if you were to track an equal weight index of those Fang stocks, and that's part of the chart, you'd see that they were up quite a bit since February, when that Fang Plus index peaked, actually about 12% over that 5 or 6 month span.
Yeah, I think you need to remind Tom, Dave, that, the Dow Jones Industrial Average was a marketing gimmick. A lot of the indexes we have out there were basically marketing gimmicks to sell newsletters and whatever else people were reading back in the 1800s, early 1900s or whatever. So I get it. And to his point, though, Dave, and when we talk about how we measure effectively what is big cap tech, because that is effectively what the NYSE Fang Plus index was supposed to be here. Is there a general argument now that maybe we need to move on from it? Maybe there's something better out there that Tom is sitting on that he hasn't quite revealed to us yet that would better capture the essence of what this is supposed to be?
Well, it's entirely possible. I mean, these days, you can't keep Microsoft out of the equation. You think about the $1 trillion club, it's part of it, along with Apple, Amazon, Alphabet, and now Facebook. So, I mean, those 5 companies right there, if you don't have them all in an index somewhere, you're not really capturing what's happening. And you can, make the argument about Tesla as well, even though it's a car company. I mean, there's a lot of focus on, technology within its business. So
yeah, you're reaching.
Yeah, Dow futures down about 500 points right now.
David Wilson, thank you so much. Greatly appreciate it.
Yeah, I did. I did. I like to poke the bear every now and then.
Romain, thank you. Okay. Equity futures down 61 on the S&P, just to make up for that lapse in concentration on this program.
This will be my last appearance on the show.
You'll be back tomorrow, no doubt. You wish. Romain Bosley doesn't want to get up this early. That's the secret in all of this. You wish, Romain.
John,
right
I get going with the marketing. I'm sorry. I get it.
I'm with you. I understand.
Correct. The Dow was a marketing plan a million years ago. I get it. But come on. Is Tesla a FANG stock?
Clearly no.
No, it's F-A... And
G that's the giveaway. No. But if you want to be concentrated in some of the big growth names, which essentially is what that particular index has become, then maybe it makes sense, Tom. I'm not here to defend or criticize it.
Yeah.
I'm sure someone's allocated to an ETF passively that tracks it.
Yeah, I mean, I look at Keefe Bruyette Bank Index, and there's a lot of work that went into that. The Bloomberg Commodity Index is a really, really smart set of mathematics. The financial, whatever it is, standard deviation index we got off the IMF, that's really smart mathematics. Most of this is marketing stuff. I'm sorry.
Yep, as is a lot of the commentary on this program, Tom. It's marketing stuff.
No way.
I mean, when people come on here and talk about active management, what do you think that's about? We caught up with Jonathan Golub at Credit Suisse 20 minutes ago, and we just asked him the question directly. Given what this market's been up to, you could take a chart of a 10-year yield, take a chart of break-evens, take a chart of real yield, spend all your time going through it all, chop, 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 ducking and diving. Then you look at the S&P 500, and we showed the chart, and we can show it again. And for our listeners on radio, there's no secret to this. Lower left, top right, up and to the right, aggressively over the last 12 months, and it's a pretty straight line, Tom.
Yeah, Justin Chart Banner emails in. Justin, thank you so much for watching this morning. And he says, you throw Tesla into the index, and I'm sorry, it's the Tang index.
Oh, right.
It works perfectly.
Okay. There we go.
There we go. Maybe that's your future, Tom.
Yeah. Every time you mention
43.58 at a close yesterday. Let's wrap this up. All-time highs yesterday. All-time highs. On the S&P 500 yesterday.
Massive
so when we're talking
this
about
morning.
this move, down 2% in Europe on the stock 600, down 61 on the S&P. Where are we now? Negative 61 points, down about 1.4%. We're coming across from all-time highs on the S&P, and we're coming off the year-end median price target on Wall Street. When we were in October, November time, when those headlines crossed about vaccine efficacy in early November and this market exploded on the cyclical side, those forecasts of anywhere near 4,300, Romain, that felt like a pipe dream.
It was
6, 7, 8 months ago.
Yeah, and in fact, we pushed back against a lot of that and really questioning a lot of those strategists just about how pie in the sky that was. And of course, including Jonathan Golub. And of course, we ended up being the ones who looked like we were wrong. But I think that when you look at the current levels here and you look at the crab walk that we've had to these record highs over the past 6, 7 weeks here, you do have to wonder whether some of the steam is running out of the engine a little bit.
Futures down by 1.4%, a bit into the bond market. You can see that at 127.62. Yields come in by 4 basis points. Heard on radio, seen on TV. Alongside Tom Keene, I'm Jonathan Ferro, together with Romain Bostick. Lisa Abramowicz is not in Crete, but she will be back on Monday.
She's not in Crete.
She's away. She's not in Crete. We can confirm that. I can't confirm where she is.
Sources.
She's told us she went to Greece. Direct source.
Sure.
Close to someone familiar with the matter and all that, said to not be in Crete.
Not sure.
On Monday, Lisa's back. Your equity market just coming off all-time highs.
Will we
in the
be
next
back on
hour,
Monday?
probably not. Secretary Buttigieg will be joining us, though. This is Bloomberg.
If you have confidence in the economic outlook, equities are usually the best place to be.
There's a threat to the sort of pure reopening trade, that some of those sort of COVID-sensitive sectors have a harder summer than people were hoping for.
That baton of growth acceleration is getting shifted from the US.
The one thing that we're doing at the moment is we just all focus a bit more on fiscal policy.
The Fed will actually end up doing what it has to do, but it may be a little bit late.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio, on TV, a simulcast of doom and gloom for the market pulls back this morning. We're going to dive into that, an important conversation with the Secretary of Treasury as well. John, I got to go right to what we've seen in the last hour. World coming to an end. The 10-year inflation-adjusted yield under 1%, negative 1.02. John, full recovery. We've come above that to negative 0.98. Crisis over.
Yeah, I don't know if it's a full recovery, Tom. I could sense in your voice you don't either. 127.95 on nominals right now. We come in 4 basis points off the lows. We had a break of 125. You've mentioned reals, Tom. We're still negative 97. We've had a big move in real yields over the last couple of weeks. So they've got a lot of attention. And when you see a price move and you try and fit a fundamental narrative to it, do you miss what is just a technical explanation? Is this just one monster position squeeze, Tom, that resets and eventually takes yields higher? Bob Michael of JP Morgan has taken that view.
Yeah, it's important what Bob Michael says. I've been going back and forth with our Ira Jersey, head of all of our fixed income effort at Bloomberg Intelligence. And mostly, John, what we talked about was the short cover on bonds. Price down, yield up. Oops, I'm wrong. And then you go the other way rapidly.
The emphasis at the Fed has turned. And that's the key element, I think, in this story over the last month. And one line jumped out to me in the Fed minutes, and this is the quote. A substantial majority of participants judged that the risk to their inflation projections were tilted to the upside. So that's not a shift in the reaction function. That's not even a shift in the forecast. That's a shift in the balance of risks around the forecast. And that shift in emphasis was enough to spark what we're seeing play out on the screen over the last month.
And on the equity markets, Dow futures at negative 514 is a headline. SPX down 1.5%, 63 points. The VIX reached out with just a kiss of 21 as well. Is that a correction, Romain Bostic?
No, it's not a correction. We're far from that. And I think Jonathan Golub kind of hit it on the head a little bit earlier here. I mean, this is still a bull market. The sustainability, you can certainly maybe question it around the edges here. But keep in mind, we've had these dips before, and people have bought these dips. Today, obviously, a little bit more severe than what we've seen. In fact, when you go back over the past a couple of weeks, we've really only had a couple of sessions where we opened lower. And then, of course, on both of those days, we closed higher here. So I think you are seeing people who do see opportunity here. They see an opportunity for rotation rather than an opportunity to exit.
Before we get to Caterina Simonetti, John, I do want to go through the data. I think we've got to do a complete data. I'm going to save bonds for you as you get ready for the real yield. Dollar churning here as well. John, I do want to point out renminbi comes back a little bit weaker. Maybe all the China news, 6.49 on yuan. We haven't mentioned that. And John, to me, the major news is what's not happening. Euro really doesn't move off the ECB announcement.
Euro's firmer, 118.37. Euro dollar out by positive 0.4%, but it's the move in the bond market that everybody's focused on. Yields are in 4 basis points to 127.78. Intraday highs of the year were 177. That was 50 basis points ago, and it was back at the end of March. And we keep beating this drum, and we have done over the last several weeks. This move is not new. This is not new. It's been developing now for the last several months.
We'll have to see. Right now on the management of money, we're going to get to this, and this is a good day to speak to someone at Morgan Stanley actually worrying about not losing money. Caterina Simonetti is with us in private wealth there. We rarely talk to people in the trenches, and we do so today. What's your biggest headache right now, Caterina, with people that say, I need to make money like it's in the market, but I don't want to take risk? What do you tell them?
Well, Tom, thank you for having me on the show. And it is such a weird environment that we're in, because on one side, our economic forecast remains to be positive. On the other side, for a while now, we have been calling for a correction, a pullback of some sort, anywhere from potentially maybe 10 to 20, 15%. And we are saying this in the context of the bull market, but we're preparing our clients for the fact that this economic cycle seems to be happening a little bit too quickly. And some type of a pullback here just seems natural and normal. And this is not the reason to exit the market, but certainly a good trigger to reposition the portfolios, to go to safety, to take some profits off the table.
Caterina, your colleagues, particularly in the investment bank, the likes of Ellen Zettner, Chetanaya, I'm thinking of Andrew Sheets as well, I'm thinking of Mike Wilson, they've been focused on this cycle as well and where we are in this cycle. And a lot of people are struggling with that as a framework because the team at Morgan Stanley believe we're already experiencing a mid to late cycle dynamic, a mid-cycle dynamic particularly. Could Caterina explain that to our audience, why we're already there so quickly?
Well, generally, these things take time and bull markets last for a while. But because of so much stimulus and because of this whole, economic reopening that we're going through, everything is happening quickly. And we seem to be going into this mid-cycle area of the market known for volatility, which is known for corrections and pullbacks. So because everything is happening quickly and economy is so stimulated and there's some developments and concerns that we're having right now dealing with inflation, with labor shortages, with higher cost of materials. On one side, we have this growth of recovery. On the other side, we have the volatility. So we think that the pullback and the correction at this stage in the recovery, in this mid-cycle transition that we, believe that we find ourselves in, it's only natural here.
Only natural, and this is a pretty broad-based pullback, at least for today. I mean, pretty much nothing of significance higher here, at least in the pre-market. Katerina, I want to go back to the economic data that we've been getting, which has been mixed. And it's been mixed pretty much for the whole year, despite the fact that most people have taken much more of a glass half full approach to it. There were a lot of surprises out of that data, a lot of upside surprises, and that seemed to fuel a big part of this bull run that we had over the first few months of the year. Those surprises have sort of flattened out. And I'm wondering if you read into that any sense here that even if the economy continues to chug along higher, the idea here that we'll be pleasantly surprised in any meaningful way is past us.
Romain, I think that one of the key factors here is that there seems to be a bit of a disconnect with the way Federal Reserve sees the inflation in the way that investors and consumers see the inflation in every single day of their life. And naturally, there are concerns. And so what we tell investors to do is to focus on earnings, to focus on quality, to focus on fundamentals, because I do believe that we are going to see the positive surprises. But we have to be very careful with our portfolio selection. We have to be very careful with our security selection. When we look at quality, we look at earnings, we look at the long-term opportunity, for the stocks to make sure that the valuations that we're seeing are actually supported by earnings, because we saw so much run up in some of the sectors of this economy, in some of the individual equity, that the question is this sustainable? So if there is ever a time to go to quality, to increase the overall quality of investment portfolios, this is the time.
Katerina, we've got to leave it there. It's always good to catch up. Thanks for joining us. Katerina Simonetti there, Morgan Stanley Private Wealth Management Senior Vice President. Let's talk about some individual names. A little bit earlier on this program, Romain brought up Apple. Apple delivering its first new high since early January. These are names that really haven't done much at all. Today's a little bit different, and I think it's worth explaining. We've had rotation on, rotation off, and this morning you've got a broad-based decline in this market. The S&P's down 66, we're down 1.5%. You see that underperformance on the small caps, that downdraft in the Nasdaq, and Apple is also down almost 2% in early trading, Romain.
Yeah, and this is significant because yesterday afternoon we were talking a lot about the breadth of yesterday's rally, the breadth of that closing high, and it was not necessarily as broad as you would like it to see, and we've seen that breadth come down here. And so then when you come into a morning like today and you're seeing everything in the red, I mean, there's no large cap stock right now in the green right now. Levi Strauss is pretty much it, and I don't even know if you can really factor that in. You talk about the Apples, the Amazons, the Microsofts, all these stocks that led us to all-time highs over the last few days. You talk about all those cyclical names, the airlines, the travel stocks, the material stocks that had us at all-time highs back in March, April, May, all of them down here today. And you do wonder if this is that pullback, if this is a correction, and if it ends up just being a reset and we end up moving back higher, or this is a real sort of walk back of that.
Is that on the edge of doom there,
TK?
It
was
almost.
Am
I getting better?
Romain
right.
Bostic is a wonderfully optimistic person. It's because he's sitting in that chair. He is at
Something
that podium.
That
the
chair.
gloom just
I think what Romain did earlier was important, though. He alluded to something really, really quite critical, and I've been banging on the same drum as well. This isn't new. Your 10-year yield topped at the end of March. Break-evens topped in May, and you're starting to see this bleed over to the equity market as well, with the banks in early June and the airlines as well. And I want to sit on the airlines for a moment. American Airlines is 20% off the highs of early June.
Yeah.
This summer is not the summer we imagined 12 months ago. 12 months ago, I think we all thought that international travel was going to be wide open. The idea that this London-New York corridor, Tom, is still not fully functioning. I had a friend fly from London to California yesterday, and I had a picture of the cabin. And in coach, there were 2 people. in the whole cabin. And Tom, that is not getting it done for these airlines.
I totally agree, John. I'm not read in on this like you are, but, you know, to mention the Secretary of Transportation coming up, I mean, South Bend to O'Hare to LHR, can you really do that at this moment? John, I'm not sure you can.
It depends who you are. You can certainly do the domestic leg here in America. That's wide open. The international story isn't.
Okay, so I'm not gonna die on the domestic leg, but I'm gonna die on the international leg.
And isn't that the problem, Tom? Where's the science here? We're going to have that conversation in a moment. Where's the science here? What's the scientific rationale not to have made a move on this? And the same data points in the same countries when it comes to the vaccine. You've got the UK coming up with a new travel arrangement from July 19th, but it doesn't have the reciprocal arrangement with the United States. So, Tom, what use is it for the London-New York corridor? And the fact of the matter is, right now, not much.
I just would say document it and get it done. John, you've lived this with your travels. We make jokes about it, folks. But, you know, all of us at Bloomberg have a whole team helping people try to get around all of these different rules. And, you know, John, it does come down to when do we get rid of quarantines? I mean, that's the heart of the matter.
It's been a nightmare for a lot of people. And we'll talk about some of this with Pete Buttigieg, the U.S. Transportation Secretary. He'll be joining us shortly, live on radio, on TV, on the infrastructure effort down in Washington as well. Your equity market down 1.6 on the S&P. We're off by 3 points on a 10-year, 128.62. We're off session lows. And what a session it's developing going into the opening bell. In about 20 minutes, initial jobless claims. And then an hour after that, the opening bell in New York City. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. In Haiti, police reportedly have shot and killed 4 suspects in the assassination of President Jovenel Moïse. According to the Associated Press, 2 others were arrested and 3 police officers who were being held hostage were freed. Still no word on who the assassins were. The European Central Bank has raised its inflation goal to 2% in the medium term. Policymakers also signaled they may treat deviations above and below that target with equal vigor. All this was part of an ECB strategy revamp aimed at bolstering the economy after what's been years of lackluster prices and growth. Tokyo looks set to stage an unprecedented Olympics largely without spectators. A new coronavirus surge has led to a state of emergency in the Japanese capital. There are multiple media reports that fans are expected to be banned from all Olympic events in Tokyo and the surrounding areas. And the EU has imposed fines totaling $1 billion on Volkswagen and BMW. Regulators say the 2 companies colluded to delay the rollout of emissions cleaning technology. Mercedes parent Daimler avoided a fine for being the first to tell the EU about the cartel. More than half of U.S. hospitality workers wouldn't go back to their old jobs, and over a third aren't even considering re-entering the industry. That's according to a poll by employment search engine Jobless. The survey underscores the hiring challenges for restaurants, bars, and hotels. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
I happen to believe that there will be a movement ahead in CapEx. We think there will be an infrastructure bill of some sort. Obviously, we're not privy to the negotiations now in the Congress. We think there's a desperate need for spending on infrastructure, but there's also a need for private engagement in CapEx.
And us to catch up with Abby Joseph Cohen, Goldman Sachs Advisory Director and Senior Investment Strategist from New York City this morning. Good morning. Alongside Tom Keene, I'm Jonathan Ferro. Together with Romain Bostic, Lisa Abramowicz is out until Monday. 42.88 on the S&P 500. Equity futures down 62. We decline 1.4%. This bond market is firm, particularly over the last couple of weeks. We give up some of that move, though, from earlier this morning. Yields are lower now by just 3 or 4 basis points to 128 after a break of 125, Tom, a couple of hours ago.
Really interesting, and we'll keep abreast of the markets here. Again, the VIX out near a 21 level, but there's some calmness here in the last hour. It is not a calm time for our Secretary of Transportation. Mr. Buttigieg, of course, we all know from South Bend, Indiana, sterling academics, including something that we all did as a kid. Could we write an essay off John F. Kennedy's Profiles in Courage? And the Secretary delivered the goods as a young kid. We want to talk about transportation. We want to talk about international travel. But yes, right now in infrastructure. Mr. Secretary, thank you so much for joining Bloomberg this morning. I lived the last infrastructure disaster, which is you drove out Indiana West and there was a point where I-80 died and you had a 2-lane highway west. We're going back to that on the condition of our infrastructure, and we're doing it because we cannot figure out how to do a gas tax. Can't you do a gas tax that will pay for the roads, rebuild America, and also be politically acceptable for Democrats?
Well, it turns out you don't have to. And what's so great about the bipartisan infrastructure framework that the president led, that a set of Democratic senators and Republican senators have come together on, is that it will deliver the biggest investment in American infrastructure in more than a generation. The biggest investment in our roads and bridges since Eisenhower, the biggest investment in passenger rail since Amtrak, the biggest investment in public transit ever, without having to ask Americans to pay any more in taxes, any American who makes less than $400,000 a year. This was a promise that the president made when he was running for president. He plans to keep that promise, and so he was very firm on that. But what's clear is that it is absolutely possible to make these kinds of investments by looking to other funding sources that don't ask that of ordinary Americans. And we're thrilled that this critical mass of Republican and Democratic senators agree. We think it's one of the reasons why so many Americans agree that this is the right thing to do. Now we need Congress to move it forward, get it to the president's desk so that we can get those dollars working, whether it's on our highways and bridges, our airports and ports, or on some of the things that are newer to the infrastructure picture, like our digital infrastructure and getting everybody online.
You mentioned Dwight David Eisenhower. I remember going off the infrastructure road of Kansas onto the 2-lane highway to his museum. All wonderful. Dwight Eisenhower had to fight his Republicans to get the vision of the interstate highway system done. How can you bring over Republicans to get a majority vote to rebuild America?
You know, I found that people don't agree on much here in Washington across party lines, but they agree on the need, as you've been describing, and as every American sees. You know, when I'm talking to House or Senate members, Republican or Democrat, what I notice that they all have in common is they're all from somewhere. They're all home right now, actually, this week during this July 4th recess. They're all home talking to constituents saying, when are we going to get this bridge fixed? Why is our airport looking the way it's looking? How are we this far behind on transit or whatever it is in their district? And so, yes, I do believe that we have finally reached this point of, if not consensus, then overlap. And I think that's why you had this remarkable sight of the president walking out of the West Wing a few days ago, flanked by Democratic and Republican senators saying, we have a deal. Now, we have a deal is not the same thing as we have a bill. That's what's happening right now, turning it into legislative text, moving it through these processes, committees that have jurisdiction over this. There's a lot of machinery, especially this month of July, that is going through its motions here in Washington. But it's resulting, I believe, in the opportunity for something that we have needed for really the better part of my lifetime, as we've watched these investments degrade, as we've coasted off of decisions that were made generations ago. You know, last time I was in New York was to look at the Hudson River tunnels, the finest infrastructure technology of 1910. And we're still depending on
look
it
at that
for the
shade,
Northeast
John.
Corridor.
Look at the shade the Secretary gives to New York City.
Mr. Secretary, there are some things that are easy to get done and haven't been done. Infrastructure is one of them, I guess. Another is international travel restrictions. We're trying to work out when we get an update from your administration. When is that going to happen?
So unfortunately, it can't be based on an arbitrary date. It has to be based on conditions. But I can tell you, as the Transportation Secretary, of course, I am as impatient as anybody to see us move as quickly as we responsibly can toward more forms of reopening. Right now, what's going on is a set of working group processes. So we've convened working groups with our international partners. There's one for the UK, one for the EU, one for Canada, one for Mexico, to determine the right pathway forward. A lot of this is based on what's going on with progress on the vaccines. Obviously, we see good news and bad news out there in terms of the variants. One moment you're reading about a variant happening across the world. The next you know, it's becoming the dominant strain here in the U.S.
And it is, sir. And if you allow me to jump in, because
confront.
we're pushed for time, the Delta variant has become the dominant strain here in the United States of America, according to the CDC, and very quickly so too. From my position personally, forgive me for saying this, but you didn't have to watch your father's funeral down the screen of an iPhone on Tuesday. I did, because of your policies. Now, I expected you to bring up the science, and I expected a quote that came from you to be used because you used it a month ago, 2 months ago. Here are the policies for our audience so they understand them. Currently, if you're a citizen of the United States of America, or if you have a green card, you can travel to the UK and you can fly directly back. If you have an H-1B visa or an L-1, you can fly to the UK, but to come back to America, you need to go to Mexico City and spend 2 weeks there in a third country to get back to New York. Sir, forgive me, but I've spoken to scientists about this, and there is no scientific rationale for that policy. So for me and thousands of others who haven't got to be with their loved ones through a critical time because of your policies, sir, there will be thousands more if you carry on repeating the same line and don't just look at this and change it. Why are you not changing the policy when we have scientists day after day say there's no scientific rationale for maintaining it?
Well, first of all, let me say I'm sorry to hear about your father. And let me also say that I am among those who are impatient to see loved ones who live across the Atlantic. Let me also say that the U.S. is going to be conservative in dealing with a phenomenon that has led to the deaths of 600,000
You keep going back to this, sir.
And so
there is no scientific rationale to draw a distinction between someone who has a green card, an H-1B visa, or an L-1. You know that. I know that. Regardless of anything you say for the next couple of minutes, it's not going to justify it. What I need to understand from you as a policymaker is why thousands of people who live in this country legally and pay taxes cannot go home to see loved ones and return directly, and why you still repeat the same line again and again and again. It doesn't make it true. You do not have a scientific rationale for this. You cannot back it up with science, sir. Why are you not going away with policymakers and doing something?
So our tools are imperfect, right? We are dealing with a country-based framework for assessing risk, when in a perfect world, we would know all the information we needed to have for a traveler-based framework. We can move in that direction somewhat. That's more refined and ultimately more accurate from a risk assessment perspective. But we don't have the toolkit to do that in a way that would be as smooth as we would want. So we're going to continue to have a strategy led by public health authorities, guided by Homeland Security, CDC, my department at the table, to reopen travel as quickly as we responsibly can. But when dealing with a phenomenon,
I'm not talking about a broad-based reopening, though. Forgive me for jumping in. No, just allow me to get this thought in, because it's important to what you're about to say. I need you to understand that I'm talking about working people in this country who are working here legally. With the stroke of a pen, you could enable thousands of people in this country who work illegally and pay taxes to return home to loved ones. And you can do that by making an equal treatment for people with an H-1B, an L-1, a green card, and a resident of this country. You know that's not difficult. That's not a large change. That's allowing people who work in this country to get back and see loved ones like they want to. And sir, I'm not going to lay on this on any thicker than I already have. You didn't have to watch your mum stand by your father's casket in a funeral 2 days ago because you won't do what I'm describing. It's easy. And us together in this conversation, I hope you go away and make the changes so that thousands of other people don't have to go through what I've gone through in the last month. Can we make that happen, sir?
So these are exactly the kinds of things that we're reviewing on a daily basis. I'm the transportation secretary. My entire job is to do everything I can to safely get people to where they need to be and where they want to be, whether it's to be with loved ones, whether it's to do business, but it's literally what I'm here in Washington to do. Nothing about this, respectfully, nothing about this is easy. We're dealing with a phenomenon that has led to the deaths of 600,000 Americans. We're dealing with imperfect information, complex policies, legacy policies. Nothing about this is easy. But what I will tell you is we are doing everything we can as quickly as we responsibly can to get back up and running.
Mr. Secretary, would you support a passport equivalent? I have a passport. I happened to study microbiology a few years ago. Why can't I get a passport, a federal passport, that says I've been vaccinated?
Well, there are a lot of privacy and technology issues, but I do think it's worth noting, you may have had this experience too. I had it when I was younger, traveling internationally, of carrying a yellow CDC passport that reflected the vaccinations that I needed to demonstrate that I had to travel to parts of Southeast Asia and Africa. We have forms of this that are frankly very low tech and out of date. How to balance that with the privacy issues is a challenge, and we've decided that it's not the federal government's job to establish these kinds of requirements, but it is important to make sure that there are ways for people who want to demonstrate that they are vaccinated to prove it. And we've seen a lot of third-party and private sector ways to do this, and I think that's going to continue to develop and needs to have continued support at the policy level too.
What's your biggest headache right now in getting this infrastructure plan through? I know you're managing a message every day, and certainly we've seen that with President Biden. This is a big emotional piece of American legislation. How do you get it through with a fractious Senate?
I think the biggest thing is not to let the politics get in the way. Look, people are impatient for this to happen, but it's been infrastructure week for a good decade or so, and we need to demonstrate that it's actually going to get done this time. The policy framework is clear. The pathway forward is clear. We need these roads and bridges. We need better airports. There are listings of airports where not one of the top 25 is actually in the United States. That's unacceptable to the president. I think it's unacceptable to most Americans. We want to get this done. The biggest thing we have to do is actually move it through Congress and make sure that as this turns into the very specific mechanical legislative text, that we're tearing down any obstacles to getting it to the president's desk. But I feel an enormous amount of momentum for this on both sides of the aisle. And our job is to make sure that momentum gets us all the way across the finish line.
Mr. Secretary, I appreciate your time this morning, and thank you very much for hearing us ask our questions and for responding them too. Pete Buttigieg, the U.S. Secretary of Transportation. Some economic data in America. Let's turn to Mike McKee for that. The wrong kind of upside surprise on jobless claims, Mike.
Although not much of one, John. It's about a 2,000 increase over the prior week, because that was revised higher to 371,000. 373,000 jobless claims filed last week. That's more than the survey of 350,000, but we're still at much lower levels than we were during the pandemic, of course. The average of the 5 years before that was 230,000. So we're getting there. It's just taking longer. The real question is not so much the initial claims that are being filed, but the continuing claims now, and that's at 14,209,000. That's the number you want to see come down as people move out of the labor force or move into the labor force and try to get jobs. So we're keeping an eye on that. And some of the states where we saw them end the unemployment benefits early, both Alaska and Iowa, which ended theirs a couple of weeks ago, saw jobless claims drop during the month. But Mississippi saw jobless claims drop by 8,000, and New Hampshire saw jobless claims rise by 3,000. So is there evidence that we're seeing people go back into jobs because they can't get extended benefits? Not conclusive yet.
Well, there's a weekly data point. Michael McKee, I want you to save us here this morning as we look at the yield market and the equity markets and the worry about the trajectory of growth. Forget about the Fed. When you read all the market strategists out there, the market economists out there, we talk about a boom economy and then a sort of boom economy and then not a gloom economy, but what we used to know. How has that timeline changed in the last number of weeks of the research you've read?
Well, it hasn't particularly changed. The psychology changes, and that's the difference maybe between the Fed and the markets. If you're the Fed, you could afford to wait. You could afford to say at your meeting that we don't know what's going to happen with inflation and unemployment. We think we have a theory, but it's going to take months to prove whether we're right or not. But if you're an investor, you've got to trade on a daily basis, and so you're trading the psychology of the moment. And the psychology of the moment is the Delta variant is getting established in a lot of places, and maybe that's going to have an impact. But again, we don't know at this point.
When we look at the continuing claims here and the trend line that we've been seeing there, Mike, it doesn't seem that it's come down a great deal over the last couple of reports here. And I'm wondering, at what point do you start to be a little bit concerned about that?
Well, that's the question for the Fed. And while we say jobless claims aren't related to payrolls in a direct way, they do have sort of a relationship in terms of where people are in the labor market. And we're not seeing people getting jobs at the rate that we want to, and we're seeing this elevated level of claims. And so they should move together. Claims should start coming down as more people come into the labor force and get jobs. But that may, at least according to Fed thinking and a lot of economists, that may not happen until the fall, when schools reopen, when the extended unemployment benefits expire for everybody, and people are forced into or able to get jobs. So that's something that's something we want to keep an eye on. And as these extended unemployment benefits end in a lot of states, that should also push that number down. But does it push it down a lot before September? That's the question.
Michael McKee, thank you so much. Greatly appreciate it. It's not a once-a-week visit with Mr. McKee, but Thursdays we do claims as well. Christine Lagarde is beginning to explain at a symmetric press conference the symmetric change in ECB policy. I believe she's going to answer some delicate questions there, and we will follow that, of course, our team in Frankfurt and in London as well. And we'll see how symmetric she is in answering some sensitive questions, perhaps certainly from the German media as well. James O'Sullivan joins us now, TD Securities Chief Macro Strategist. Jim O'Sullivan has been extremely good at linking in market economics into what it means for the markets. We're thrilled that Jim O'Sullivan could join this morning. Jim, I want to talk about the idea of the signaling processes that you see out there. Is the market signaling the Fed, or is the Fed signaling the markets?
I mean, it's a good question. And yeah, frankly, we're a little puzzled as well by the rally in the bond market over the last couple of months. I mean, for the most part, I mean, the U.S. economy seems to be recovering fairly well. Obviously, we just saw an 850,000 increase in payrolls last week. The ISM numbers, have come down a little bit. They're still over 60. And of course, it's inevitable that the boost from reopening and from fiscal stimulus will fade. I mean, we don't expect to keep seeing 7 or 8% growth indefinitely. So inevitably, there's going to be some fading of those over the next year. But I mean, at this point, yeah, the economy seems to still be pretty strong. And I mean, it is a little bit of a puzzle, frankly, that the bond market has rallied as much as it has over the last couple of months.
It has rallied because of price up. I don't want you to, go into full fixed income mode and certainly overnight repo mode, but does it concern you to see the oddities in the very short-term market? Link that into what our listeners and viewers live every day in a more long-term bond, note, and bill market.
Well, when you say short-term market, you're talking about the very short end of the curve, or just the daily?
I'm talking about the wall of cash that is out there that has distorted all of the trust market inside 6 months.
Well, I mean, there's certainly a flood of money in a QE world that the Fed is in right now. I mean, certainly the Fed is still buying 120 billion a month of bonds and pumping that money into the banking system, essentially. So bank reserves are being flooded. So there's a huge amount of short-term money. And of course, the Fed did just tweak its short-term administered rates, the repo rate and the excess reserves rate, to push those numbers back up. But we're living in a world where there's massive monetary accommodation, and that's putting short-term rates at close to zero. And that's not about to change anytime soon. I mean, what's being talked about the Fed, of course, is just backing off on the QE part of the program. And that'll slow down the increase in all these reserves, but there's certainly no talk about taking them back anytime soon.
Yeah, the monetary accommodation remains. The expectation is for it to remain. Let's talk about the fiscal policy and fiscal policy accommodation here. There was a high expectations heading into this year about the type of fiscal stimulus and fiscal spending we would see. That hasn't quite worked its way through Congress, and now there are some doubts about whether we'll see, the full proposal actually ever come to fruition here. Jim, how is that factoring into your outlook?
Yeah, I mean, that probably is a bit of a factor for the bond market, although I think it's always been true that the next round of fiscal policy was going to be more of a long-term plan over the next 8 to 10 years. So it's not so much about 2022 or even 2023. I mean, meanwhile, it's always been true that the huge amount of stimulus that's been in place due to COVID over the last year and a half was very much front-loaded, including the 1.9 trillion stimulus plan that was enacted in March, shortly after the president took office. So that stimulus is going to fade as you get into 2022. And that is a reason to expect growth to be much slower next year than it is this year. And of course, that's almost inevitable given we're talking 6-7% growth this year. But meanwhile, yeah, it looks like it's a challenge to get that long-term plan in place. There's a lot of negotiations still to be done. In the end, it looks like something will be done. There seems to be some kind of an agreement on the infrastructure, small part of the infrastructure part, but there's a lot more negotiating to be done. But in any event, that longer-term plan is more about the next 8 to 10 years. It's not so much about 2022.
Hey, Jim, it's good to catch up, sir. Thanks for your time this morning. Jim O'Sullivan there, TD Securities Chief, US Macro Strategist. If you're just tuning in on TV, on radio worldwide, here's the price action for you. Down 59 on the S&P 500. We declined about 1.36%. Off session lows, but still declining. A similar story in the bond market. Treasury yields saw a break of 125 a little bit earlier this morning. We're now at 127.62. We're down 4 basis points. A little bit later on the open, in about 21 minutes' time on Bloomberg TV, we'll be catching up with Jerome Schneider of PIMCO. And what a timely conversation, yes, Tom, to have on this bond market. This is not where people thought we would be at this point of the year.
And that could be a 1-hour conversation. Jerome Schneider, just expert at linking in the duration market, call it 6-month T-bills, even 3-month paper, on down to, as I mentioned, John, the trust bond market is shattered. This overnight repo market, it's all a bunch of highfalutin mathematics and knowledge. They talk in Greek, John, but Jerome can translate that.
What did you make of that claims data, Tom? 373, just the wrong kind of upside surprise there.
You know, I'm glad you mentioned it, John. We didn't have time with Mike McKee. I looked at the chart, and by no means does it violate the trend to a better set of statistics, a better feeling about employment in America. It's another data point, but the continuum of the trend is still very much intact.
I'll run you through the opening bell on TV. Tom Keene will do that on radio, and then going into the close, Romain Bostic putting in the long shift. Romain, what's the focus for you today through the session going into the closing bell?
I think the breadth of the sell-off combined with the lack of breadth that we saw in the rally over the last few days, and whether you put that together and whether it spells the idea that some of the steam is maybe coming out of this market.
TK?
I lost my train of thought. I was thinking about Italy, England, and what they would.
You don't want to talk about travel restrictions.
No, the breadth thing is like a big deal. Frankly, the breadth is a big deal. It has not been there. Yeah. And that's worth a lot of study.
Yeah, and we're going to have a good conversation. We should point out that game was aired actually during the close yesterday.
How does that work, Romain?
Caroline Hyde spent the entire show looking at her phone, checking the score.
Romain Bostic.
The entire show.
Alongside Tom Keene, I'm Jonathan Ferro.
That's outrageous.
Equity futures down 57 at 42.93 on the S&P 500. From New York City this morning, good morning. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. A 2-week search for survivors of that collapsed condo in South Florida has come to an end. The operation has now shifted to a recovery effort after authorities concluded there were no longer any chance of life in the rubble. Crews have recovered 54 victims, with 86 people still unaccounted for. It's another sign that the rapid spread of the coronavirus Delta variant could wreck Europe's summer. France is warning its citizens not to vacation in Spain and Portugal. Those two countries have the highest 14-day case notification rate in Europe after Cyprus, and both rely heavily on tourism. In China, the government signaled the economy needs more support from the central bank. Authorities hinted that the People's Bank of China could make more liquidity available to banks in order to boost lending to businesses. One way to do that, of course, is cutting the amount of money the banks have to keep in reserve. China's recovery from the pandemic has shown some signs of faltering recently. And in China, Tesla has unveiled a significantly cheaper version of its locally built Model Y SUV. That's after a string of negative publicity that may have hurt consumer sentiment towards the electric car-making pioneer. The so-called standard range Model Y starts at a little more than $42,000, about 20% less than the original longer range Model Y. 36 states have sued Google, accusing the company of abusing its power over app sales through the Google Play Store. The suit filed in San Francisco says that Google used anti-competitive tactics to thwart competition. The company says that the lawsuit gets it wrong. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Good morning, everyone. Bloomberg Surveillance. Just a very interesting half hour to speak to the Secretary of Transportation on infrastructure and on international travel as well. We do this with the markets, somewhat of an improving tape this morning off the great difficulties that we saw 2 and 3 and 4 hours ago. Right now is a special moment, not only for Bloomberg Surveillance for all of New York City, but indeed it is a national story. Eric Adams is the Democratic nominee for New York City mayor. This is 2 other candidates did not go for a recount and conceded in the last 12, even 18 hours. Joining me now for a conversation with the Democratic nominee is, of course, Romaine Bostick in for Lisa Abramowicz. And we're absolutely thrilled to have Shelley Banjo with us. She has driven our coverage here at Bloomberg. This started out as, another race, and then it became something different. Eric Adams, thank you so much for joining us this morning. I'm going to let Shelley talk about ear piercings and all that we've seen in the last 24 hours. I want to talk about your first meeting as mayor with the New York Police Department. How do you envision that will go?
Well, first, it started already, and it's not with the department, it's with the union heads. I had a conversation with Pat Lynch, a conversation with Ed Mullins, a conversation with the president of the DEA. It's about going behind closed doors and say, let's turn a new page. I said this over and over again, the prerequisite to prosperity in the city is public safety and reform. And they are eager to sit down with me and say, how do we move policing into the 21st century, deeper into the 21st century, where we reestablish the relationships between police and community, because our cities will be controlled by the good guys or the bad guys. And right now, all across America, the bad guys are winning. And I'm going to stop that immediately.
Are you going to do that with Dermot McShay at the helm?
No, I'm not. I've made it clear that my police commissioner is going to be a woman. We're going to finally bring the entire city, the largest police department in the country, into the 21st century of women leadership in law enforcement. Yeah. And I'm look at 3 of the candidates that I've been communicated with.
And I'm sure you know, obviously, being a veteran of that force, that's not going to come easy, Eric. We've seen the fraught relationship between the police, the rank and file, the unions, and, of course, the mayors of the past here. You've also had a relatively complicated relationship despite being a veteran of that department here. How do you bridge that, Eric? How are you going to do that in a way where the police, which are a mighty force in this city, Eric, some would say even mightier than the mayor himself?
Well, first of all, it is easy. And those who state it's not going to be easy, they don't know me. I had difficult challenges in my life, being beat, arrested by police officers, assaulted, went into the police department for reform, moved up through the ranks of captain, became a state senator, now bar president, reversed diabetes by changing my diet. And so difficult challenges is not something that I run away from, I run towards. What we must do is stop talking at each other around reform and safety and start talking with each other. And you're going to see in the first year a complete change in the atmosphere of public safety and how our police officers respond. We're going to rid the bad cops. We're going to back our good cops. And we're going to reestablish the relationships in our communities. And it's going to be done in year 1. I promise you that.
The 3 women that you're currently in conversation with, are they within the New York Police Department, or are you looking outside?
What I don't want to do is say, is it bigger than the bread box or smaller than the house? Because that limits the number of potential candidates, and many of them are working right now. And I don't want to in any way jeopardize what they're doing. I will reveal those numbers immediately after I win the general election in November. I revealed the individual I decided on.
Fair enough. And another big force to be reckoned with is obviously Governor Andrew Cuomo in Albany. You have had a checkered past, so to speak, with him, but you guys have run in the same political circles for almost your entire adult lives. Did he call you to congratulate you? And what's the first thing you're going to try to work with him in Albany on?
And we don't have a checkered past. Clearly, we are both strong in what we believe. We know how to sit down and communicate. We've operated together when I was in Albany, and I'm looking forward to having him as a partner as we deal with, number one, public safety. I cannot really emphasize this enough. We're not going to deal with major parts of our economy, tourism. If we have shootings in Times Square, no one's going to get on the subway system if we continue the violence there. And so we're going to first deal with making our city safe. And then we're going to use the dollars that are coming from the federal government to go after the feeders of crime and the feeders that prevent people from finally leaving institutional poverty year after year. And I believe that having a partner in Albany, we could accomplish this task together.
Eric Adams, they're going to study your candidacy, the path of this mayoral race for you in Brooklyn, in Bronx. They're also going to study it in Boston and also in Boise, Idaho. You're going to have a national ramification for all Democrats. What does your victory say about the certitude of the left in the Democratic Party?
Well, if you are a DSA candidate or if you are a Republican candidate, you don't want to be pushed on the train or slashed.
Right.
So I think that what you're going to see, I'm the face of the Democratic Party. I keep saying this over and over again. I won 4 boroughs in the city of New York. The only borough I did not win is Manhattan. My message resonated with everyday working people. And it didn't matter your ethnicity, your gender, it didn't matter worship. And I think that you're going to see this message resonate across this entire country. And it's an opportunity for us to understand that we don't have to talk at each other. We are in this together. And I'm going to bring the city closer together so that we can overcome not only the pandemic, but also the pandemic of unemployment, of violence, and inequality.
Very quickly, Eric, we are on television and we are on radio, and a number of radio listeners have emailed in and said, what's the piercing look like? Where's the piercing this morning, Mayor Adams?
Look at this.
It's a gold earring. My son and I, we attended a meeting with a group of young people during the campaign, and they said that we will vote for you if you commit and promise to get your ears pierced, if you win the primary. And a promise made is a promise kept. And I did it yesterday.
I can assure you the 108th mayor of New York did not go through this torture. Eric Adams, thank you so much. We look forward to speaking to you again. Let's be clear, the Democratic nominee for New York City mayor. I believe there's an election coming on as well. Shelley Banjo, very quickly here, your thoughts on this conversation.
I thought it was great. I mean, Adams has a real big challenge ahead of him. He's made huge promises on crime. He said, I'm going to reduce crime. That is not an easy thing to do. And if he doesn't do it quickly, people are going to get upset.
Romaine Bostick, your thoughts, please.
Yeah, I wanted to get some questions in there on education, too. That's obviously a big factor, a big part of the reason also why I think he lost Manhattan. It'll be interesting to see how he addresses that.
Very good. That was a very interesting moment. We leave you with the interesting moment of the market. Futures at negative 57, Dow futures just near negative 500. Stay with us. The open is next. On television, I believe they'll talk about the markets. Good morning.